Okay. Good evening to all of you. I think we can start the session. Sorry for delay, because it takes some time to come in and after that to refresh. And let me start the session. This is the part 2 discussion of the SL3 June 2023 paper. Then in the first part, we have completed the company taxation question, which is resident company taxation question fully. The 30 marks done from the rest of the part. That's mean from the part or section B of the paper. From part B, I'm starting today and going forward, I'll move to the section A, question 1 and question 2. Then let me share the screen and we will start the session. Then, which is, let me take the discussion. In this, I will start from the question 3, part B onwards, the usual discussion, which we need to complete as the balance part from the last discussion. Then here, this one already completed, which is the computation. Then I need to go for the writing part of the things to discuss and look at what are the areas and what are the areas it has tested. And the second thing, how are you going to answer? And the third thing, rather than the very detailed answer, I need to go for how a student approach the question by reading the question and applying it's applying the provisions of the Inland Revenue Act to the given scenario without just writing the theory parts. Okay, then rather than going for one of the detailed answer, I need to come up with those areas to highlight. And while reading the question, if I need to do something, I am adding the things. Okay, then let me come to this, the part B, which is on the last session. I have taken the pre-scene and all the little bit of the information with reference to pre-scene I have given. Then with that, if any requirement to go for pre-scene again, I will come to that also. Then here, it's a part B. Then it's a 7 marks and the 3 marks. Altogether 10 marks. This has tested the part, it's a Roman 1 and Roman 2. Now we will look at first, I need to go for requirement. After reading the requirement, I will come to the facts of the question. What's the requirement? It's a describe. This is the action verb asked from y'all. Then in the describe, the tax implication. Now you have to describe a tax implications. This is that. And arising from the investments. This is the next thing. Arising on the investments in the greenhouse and farmlands project. Now it's based on here, which is, let me check the chat box. Yeah, sure. Which I need to tell at the end of the session, any questions, it's allowed. It's not at the total end of the session. Then let me complete one by one. After I'm completing this part, then you all can ask the question from this part. After question 1, any questions on that? After question 2, any questions on that? And overall, whatever you need to clarify, then that also can be asked. First, let me complete part by part, and after that, you are so welcome to ask the questions. Then here, which is I'm again coming to this, tax implications arising from the investment. Now, 2 investments given. It's the greenhouse and one is the greenhouse. Other one is the farmland projects. Greenhouse and the farmlands project. These are the 2 projects. Then your answer should include the following. The investment incentives and allowable deduction available to AFL. Now, we don't know what is this AFL. We have to read the given facts of the scenario. Then here, why I'm always telling, I'm not telling you to approach for this, but if I'm the student, what I'm telling, what I'm doing, I'm go for the requirement. By going for requirement, I can understand what it has asked. Then at least some feeling in my mind. Then there are two projects, and these things I need to look at when reading the facts. Then it will come to my mind. Okay, this has asked. Then I need to take the information from the scenario, and I can relate the theory parts of the act like this manner. Then just to have a little bit of idea, I think the reading the requirement and know the requirement and coming to the facts, it's good, but it's up to you. Then here, which is the investment incentives and allowable deduction. It asks two things. One is the investment incentives. Then all of you all know, to claim the investment incentives in the Inland Revenue Act, we have two provisions. One is the second schedule and other one is the sixth schedule. In the second schedule, we have for investments, we have the enhanced capital allowances as same with reference to the sixth schedule, which for the temporary concessions, we have investment incentives. Again, the enhanced capital allowances and going forward. Then the application of the sixth schedule and application of the second schedule, there are investment criteria, the conditions to be satisfied, and there is a time limit. Specifically, it's time limitation not applicable for second schedule, but applicable for the sixth schedule, which is 6 years from the year of assessment in which the Inland Revenue Act has implemented. Then the 6 years will be completed to 23-24. Then it's if you are in your year of assessment 22-23, then it's a sixth schedule only the application that comes only for 23-24. After that, it has lapsed or expired. Then these things should be come to your mind when looking the wording of the investment incentives. And the second one, allowable deductions. When it comes to allowable deductions, now in the Inland Revenue Act, then allowable deductions, we have main deduction rule and we have specific deductions. Then we need to look at which kind of the allowable deduction is this application of the two investment it's going to ask. Then it's starting from section 11, 12 and going forward section 19 until the business loss and investment losses. We have many more specific and the common or main deduction other than disallowable expenses. Then therefore, those things when I'm reading now, okay, which it's an investment incentives and the allowable deduction is asking from this question with reference to so-called investment on greenhouse and the farmland. That's what came to my mind. And next one, income tax rates, exemptions, if any. Now it's asking income tax rates or exemptions, if any, and what implication of the supply of organic fruits and vegetables to CSL. Now again, a different thing. One is the income tax rates and the exemptions with reference to income tax. Now again, looking for farmland, looking for greenhouse, then what comes to my mind, which is on the agro-farming, there is exemption. Is that applicable for this? And again, any VAT implication is asking on the VAT. The indirect tax, any VAT implication of the supply of organic fruits and vegetables. It's an unprocessed or not we need to look at. Then on organic fruits and vegetables, and they are going to supply. Then it's the application of the SCN. Okay. Then it asking income tax rate exemptions and VAT on the supply of the organic vegetables to CSL. I'm sorry, it's a CSL. Then this is asking investment incentives of the AFL. Now these things you have to highlight very carefully. If not, you are going to answer for all the two criteria to one company. No, it's asking for two different organizations, two different aspects. Now let me complete this part and come to the second part, which is on the few information given on the part B. As stated in the pre-read, the following business proposals were tabled to be taken up as discussion at the recent board meeting. Then SPL's investment proposal. Now we have SPL company, then In that, they have one investment proposal. And again, I'm coming to here, CSL's investment proposal. Now, two companies, two investment proposals. In that, what's the SPR's investment proposal? Invest in farmland by acquiring the land. Please remember now, land which is in the, they are asking on the investment incentives. The land is not a depreciable asset. The investment incentive is applicable only for the investing in a depreciable asset on that particular investment capacity. Then here, the acquiring the land, it's a the approximately cost of the land is the land is rupees 50 million. To cultivate vegetables and fruits in the northern province. Province is very, very important. This is the province. To what? Cultivate fruits and the vegetables. That's the perspective of the farmland. Then they are going to cultivate. They ask about the income tax exemption also. The expected total investment, rupees 500 million. It's a US dollars 1.6 million. Now looking for this. Then when it comes to investment incentives on the farmland project, I'm quickly pointing out this thing. I'm starting from the investment. It's an investment is of 1.6 million. Then we have to go with two schedules. One is a second schedule, other one is a sixth schedule. We cannot go with the second schedule. You have to explain the reason. And secondly, it's a sixth schedule we can go. Then in the sixth schedule, again, it's a less than 3 million US dollars. And again in that, which is you have to provide the capital allowances only on the depreciable asset. Then you have to directly tell the 50 million worth of the land, it's not eligible for the enhanced capital allowances. It's not a depreciable asset. And the second one with reference to this one, we need to look at whether this going to the SPLs as the umbrella of the SPLs or as a different or separate entity. Now come to this. SPL wishes to make this investment using newly formed company. Now this is a new undertaking. A separate company, Agri Farms Private Limited. That's why it's the AFL. In your first requirement of the 7 marks question, it has asked about the investment incentives and allowable deduction available to AFL. Then here, which will be fully owned subsidiary of SPL. Now they are associated person, no harm, it's a new undertaking. They are going to do the agro farms. Then therefore, when it comes to investment incentives, only 6 schedule they can apply, but there is a time limitation. What's the time limitation? They have to quickly take up their decision and they have to implement in from 1st April 2023 to 31st March 2024 immediately within that period. If not, this application of the enhanced capital allowances on the investment is not applicable. That's the first part. And the allowable deductions. Now what they are going to do? Then it's the, in here, it's a newly formed company called Agro Farming and Agro Farms Private Limited, cultivate vegetables and fruit. For cultivate vegetables and fruit, what's the allowable deductions? It is in the Inland Revenue Act. Is that main deduction? Main deduction, it has provided the expenses incurred for the production of income other than capital nature during the year you can deduct. But interest cost, which is on the capital allowances, balancing allowance, these things like that. But other than all of these, from the specific deduction, we have section 15. The section 15 is for the agricultural startup expenses and the research and development expenses. Under agricultural startup expenses, in section 15, subparagraph 8, it has very clearly provided to clean up the land for the cultivation and cultivating land with the plants. And after that, animal husbandry, poultry, and the fishing, all these things are there. Then for relevant to us, the 1 and 2 points is important. Then we can deduct the expenses incurred for this cultivate vegetables and fruits. with reference to this land on behalf of the Agri-Farms Private Limited, the allowable deduction I can take. What's the important of that? It's not only the recurring nature or the revenue nature expenditure, even capital nature, you can deduct. Lamai, that's all for the first thing. While reading the question, I have taken note. And the second one, which is SCL's investment proposal. The investment in greenhouse for organic agriculture located within the hotel premises. They are going to go for a value chain. Then the expected investment 150 million. Then expected investment 150 million. US dollar 0.48 million. Anyway, this seems to be the invest in greenhouse for organic agriculture located in the hotel premises. Then it's a greenhouse. It's a basically we need the land. And there may be some accessories. Then it's again even for this applicable the sixth schedule, not the second schedule. Again, we are in the doubt that which is it's only the land and accessories there may be. Second one, construction of an Ayurvedic treatment center and to recruit a qualified, experienced doctor to provide treatments to the guests. Now come to the question. It asking greenhouse and farmland project. Are they asking on the construction of Ayurvedic treatment center? No. Then it's asking on these two investments. And there is something for next, maybe. And the next thing, the board of directors of CSL are currently evaluating the following positions. 1 and 2, to assign the investment and management of the greenhouse project of the hotel to AFL. Then it's a managing of this. It's a greenhouse project. It's going to give the AFL, which is supposed newly going to form organization. Then the second one, to purchase organic fruits and vegetables from the greenhouse operated by AFL at the arm's length price for the guest who will be the prioritized in the hotel for the Ayurvedic treatment. The prioritization given for the clients who are coming for the Ayurvedic treatments like that. This is the arrangement. And next it has given, it is expected to complete the farmland and greenhouse project before the end of the year of assessment 23-24. And then we are good. So very clearly given in the paper, this investment going to do within 23-24, therefore, for the, which reference to this, which is on the application of the sixth schedule, we can go. Now in the SCR's investment proposal, which is invest in greenhouse for organic agriculture located within the hotel premises. Lama, it's going to conduct it as under the umbrella of the CSL. Then we need to look at whether this is new undertaking or expansion of the business. Then the next, here, income tax rates, exemptions for agro-farming exemption is there. And agro-farming exemption, it will be for the 5 years it has given. Then for 5 years, it's from 2019-20 onwards, 19-20, 20-21, 21-22, 22-23, from 23-24. After that, if there are the 30% rate is applicable. And when it comes to the VAT application, VAT implication to supply of organic vegetables to CSL. Yeah, it's a CSL. Then it's a supply of organic vegetables, which is unprocessed agricultural products. Then any unprocessed supply of any unprocessed agricultural products, it is exempted from the VAT. Now, that's all for the 7 marks you need to take. Then let me come to the answer. This is not a detailed answer. What I have done, like I have discussed with you, I have analyzed the question. Then in the question, which is you have to describe on tax implications, on investments, two investments, greenhouse project and the farmland project. Then it's the how are we going to describe this. The examiner has given two particular points. You have to definitely go with this. Then you have to address all the sub points in this bullet 2 in your answer. Compulsory for you to get the marks. Then the next, the points to be extracted from the scenario, the same thing I have done, which is SPL's investment proposal, which is application to Agri Farms Private Limited, which is AFL, points extracted from the question, nothing other than anything. And I have applied those things to the provisions of the act. I'm not going for a detailed answer, then I need to go for the summary. Investment in farmland, then it's a cost of the land, 50 million, not a depreciable asset. It's very important. And the expected total investment, 500 million, it's a US dollar 1.6 million equivalent. It's given the US dollar is a parameter is a US dollar, but you can invest in whatever the currency, it should be equivalent to the US dollars. Then what are the provisions of the investment incentives? We have 2, 6 and second schedule is a less than 3 million US dollar. Then second schedule shall not be applicable. The negativity we have to remove. And the sixth schedule can be applicable subject to the period of limitation, 6 years from the year of assessment 1819. The last year is the 23-24. New company incorporated, it's a new undertaking, not the expansion of the existing business. And the second is a province, it's northern province, then we can go for 200% of the enhanced capital allowance on the depreciable asset other than intangibles. Then, if so, if this condition is okay, as per 6th schedule, enhanced capital allowances up to, it's a 200% on the depreciable asset. Then other than intangible asset, you can claim the enhanced capital allowance, and it is again for the normal capital allowances or regular capital allowances applicable under section 16 and the 4th schedule. Okay. Then this is on that. You can elaborate this for a detailed answer. This is the answer format. All the things which extracted from the scenario. And the next point, which is on the CSL's investment proposal, investment in greenhouse for organic agriculture. Then for greenhouse project, 100% of enhanced capital allowances on depreciable assets other than intangible asset, apart from the capital allowances awarded under the 4th schedule. Because it's a total detail was not provided, but we can take this, which is on the greenhouse project. If the other than the depreciable asset, if it is taking on a new undertaking, we can go for enhanced capital allowances, not for second schedule. And the new company will be incorporated. Then if a new company is incorporated, if the industry is on the agro-farming. Being agro-farming industry exempted from income tax. Here, it's from the 1st April 2019 onwards, the period of 5 years, the exemption has been provided up to 23-24. Anyway, if they have taken a new company and if they have done this, then what has happened? The 23-24, they can take the benefit. Then after that, it will be taxed at the rate of the 30% as per the 4th schedule, subparagraph 4. That's on the part of the exemption or application of the tax rate. And the allowable deduction, I have not quoted everything from the section 15, but summarized version I have taken. Then the allowable deduction, specific deduction, section 15, subparagraph 2, which is on the agricultural startup expenses as provided in the provisions of the Inland Revenue Act. Then irrespective of the capital nature, it only shall be covered the section 11, subparagraph 1, which is incurred for the production of income. Then other than the capital nature part is not applicable for research and development, agricultural, startup expenses, and the marketing and communication expenses. Then here, that's the, and the VAT implication as per part 2 of the first schedule. So the VAT at the supply of unprocessed agricultural products are exempted from VAT. This is unprocessed, then it is exempted. This is for small explanation and for application of the answer format of that 7 marks on the investment incentives. Now let me come to the balance, which is the Roman 2 part in the part B, which is CSL wishes to obtain services from doctor. Then doctor, it's a professional. Now these things should come to your mind. Then who are not employed by CSL for the proposed Ayurvedic treatment center. Now that's a relationship for this Ayurvedic treatment center. They are going to hire a doctor. Then doctor, it's an independent professional service provider. Then here, discuss the withholding tax obligations to CSL. Withholding tax obligation of CSL, then always think, remember, and you know anyway, it's discussed, it's not a discussion of the pros and cons, but you need to analyze the scenario and you have to argue on the points and you have to explain them. The withholding tax obligations for CSL. Then for withholding tax, we have two parties, withholding agent and the withholding. Now this is asking the responsibility or obligation of CSL, withholding agent, because we have the doctor who is a recipient. Then when it comes to the CSL, withholding agent, what are they asking? In relation to service fee payment. I had to make the service fee payment, being a CSL. Then on the service fee payment, what's the obligation? Made to the said doctors, according to the provisions of the Inland Revenue Act 24/2017 as amended, your answer should cover the obligation, rate and exemptions, if any. Now see your answer format. What should be answer? It has given by the examiner. It's for the 3 marks. Then it's a 1 line for obligation, 1 line for rate, 1 line for exemption. The 3 marks, you can definitely take entire 3 marks. And this has tested the tax administration provision. Your open book referential material that is with you all. If you are familiarized with these things, which is on the section 85 provisions, then it's really easy. And at that, then there's something to be memorized. Obligation, what is the obligation? Obligation is the under section 85, then subparagraph 1A. Then according to that, any from the independent service provider, if you are taking a service, if the payment is more than 100,000 per calendar month, we have to deduct 5% of the withholding and remit it to the Department of Inland Revenue on or before the 15th day of the next subsequent month. That's the first obligation. The rate is a 5%. Where rate has given in the first schedule, the subparagraph 10 in that particular subparagraph, it's there. Exemptions. Now, when it's looking at the exemptions, don't go and think about a third schedule. Oh my God, in the third schedule, we don't have any exemption on the service fee. Yes, I agree. But there is exemption, rather exemption is a kind of the exclusion. Then what is that? We don't need to pay tax, withholding tax, if the amount is less than 100,000, 100,000 or less than 100,000. It's exceeding 100,000. Then therefore, that is a particular exemption. Then therefore, this obligation, rate and exemption, you can write quickly. And let me come to that 3 marks also. This is the correction. And here, again, I have came up with the answer format, not for the total answers. The obligation and rate as per section 85(1)(c). It's a section 85(1)(a) for the teaching, lecturing and that part. And the commission and the brokerage thing is a 1C. subject to the exclusions mentioned in section 85(3), with effect from 1st January 2023, a person shall withhold tax at the rate of 5%. The first schedule, para 10 and all the details given of the payment where such person pays a service fee with a source in Sri Lanka to a resident individual who is not an employee. For you to answer these things, see how the clarity of the question. Then it's the very clearly given who are not employed by CSL. Then if you know the parts of the theory, and if you can carefully read this question, obviously you can obtain the marks. No doubt at all. Then the next, service fee exceeds ₹100,000 per calendar month. And here, the who shall be liable, I'm coming to this because it's a doctor. It's a part C in that given. Therefore, services provided by the individual who is in the capacity of the independent service provider, such as doctor, engineer, like that it has given. And therefore, CSL shall deduct 5% of the WHT from the doctor payment exceeds ₹100,000 per calendar month, and it should be remitted to Department of Inland Revenue within the next month or no before the 15th day of the next month. If they have not done so, then that particular expense, the particular doctor, whatever it has charged to the income statement, it shall be disallowed from the hands of the CSL, and the exemption or exclusion, it's a service fee does not exceed ₹100,000 per month, then we can have that parameter not to deduct WHT. That's for the 3 marks. It's seems to be easy. Don't agree with me. It seems to be easy. I mean, if you know the things, then it's really easy. That's how it's a 10 marks going. And which is the case law provision, and it's for the 5 marks. And let me complete the 5 marks first. What it has asked in the Roman 1, advise whether the company can deduct the payment made to the senior business development manager. Payment made to the senior business development manager. This is the payment. Inbound to us in the income tax calculation into year of assessment 1920. Don't worry about this, the past year of assessment, because the assessments are the assessment issued for previous years of assessment, but very tight to your syllabus, the question has asked. Then further provisions of the Inland Revenue Act number 24 of 2017 as amended, support your answer with the decided case law. Now you have to support your answer based on 2 things. One is the provisions of the Inland Revenue Act. This is there. And the second one with the decided case laws. Now, before answer, before question, the detailed information of the question, let me come to this. You have to provide advice. Definitely, you have to give a recommendation. In that, whether a company can deduct the payment made to the senior business development manager. To deduct the payment, or rather if I have taken to deduct the expense, then what are the criteria you need to satisfy? You have to think. And it's in the provisions of the Inland Revenue Act and the decided case laws. Now let me come to the facts. Now you have to think to deduct the expenditure. What are the things to be satisfied? Now I'm coming to the details of the question. The Department of Inland Revenue, DIR, conducted an audit of the books of Paradise Travels Private Limited, from the 3 companies, one of the company given, then PTL for year of assessment 1920, and the Assistant Commissioner, the conducting the audit, highlighted the following points with respect to income tax. An assessment was issued subsequently. Then already assessment has been issued. Then PTL had made a special lump sum payment to its senior business development manager. What is the subject matter? Special lump sum payment. This is the subject matter. Then it's paid to senior business development manager. Now you have to ask the question, why that kind of a lump sum payment paid? Then from the company, who resigned from the company during the year of assessment 1920. This payment was now the nature or the purpose of the payment. This payment was in respect of the covenant to restrict him from acting as an employee or director or consultant in the field of business development for any other competitive business enterprise that is similar to PTA. Now, this is the purpose of the payment. Then here it seems to be very narrow purpose, but that's the purpose. Subject matter is a lump sum payment. Paid. Now what it has done with the intention of, what is the intention of this payment? The intention of protecting PTL's existing market share in the inbound tour operation sector. Very, very important point. The company has deducted this expense when computing its income tax liability. This is the outcome. They have deducted this when computing the income tax liability of 2019-20. Then, however, this deduction was disputed by the assistant commissioner. Why disputed? Now, let me summarize, taking 2 minutes. This is what? This is special lump sum payment. That's my expense. Now, special lump sum payment. Now, think, is it covered under specific deductions given in the Inland Revenue Act? 12, 13, 14, 15, 16, 17, 18, 19? No. Not covered. Then, what's the bracket? You have to put the main deduction rule. When it comes to main deduction rule, what are the criteria to be satisfied? The expense should be incurred during the year. It has incurred during the year 1920. Second one, it shall be incurred for the production of income. Yes, Lamai, this lump sum payment has incurred for the production of income. It has given with the intention of protecting PTL's existing market share. Now, to protect existing market share, we have incurred this expense. None other reason there. Then it is incurred for the production of income. And third one, other than capital nature. Now the question is, why the lump sum payment has paid? It's a covenant to restrict him from acting as an employee, director, consultant in the field of business development for any other competitor business enterprise that's similar to PTL. It has paid for the protect or the restricting him to acting as in these positions. Is that paid? This payment is made for only for 1 year, only for 2 years, 3 years, or long-lasting payment done with this purpose. I don't know what's the amount, but it is a long-lasting payment done as a lump sum payment to cover my, to protect my organization. Then Lama is a capital nature expenditure. The enduring benefit, or it's a benefit, goes to more than 12 months period. Then therefore, this is as per the provisions of the Inland Revenue Act, we cannot deduct. And they have asked in the second thing, decided case law. What is a decided case law? We have 4 types of the case laws in your syllabus. One is to whether it's an adventure or nature of the concerning of a business or not. And the second one, the expenses to be deducted, whether it's incurred for the production of income or not. Third one, to expense to deduct, is a capital nature or revenue nature. And the fourth category is the plant. Then when it comes to this third one, is that incurred in the capital or recurring nature, then there is a capital nature transaction. What's the case law? We have a same scenario, which is a one director leaving the company, and we have given a lump sum. Same thing also has been done in the past. Then for that case law, we have to take into consideration, and you have to take the this particular answer, which is a New Portman, that one versus Clear. I think I'm correct. Then this is the for the 5 marks. Let me come to here, which is for the 5 marks. Question 3 part B, and this is that. First, I have quoted from the section 11, as I have mentioned, which is subject matter, special lump sum payment. I have just taken the things from the question, and its answer format it has elaborated, which is subject matter, special lump sum payments to senior business development manager. This is that, the lump sum payment. And reason for the payment, covenant to restrict him to acting as the particular positions in the field of business development for any other competitive business. Then with the intention of the protecting market share, it's very important. What is the opinion of Assistant Commissioner of Inland Revenue? Deduction was dispute. Our advice, whether Assistant Commissioner's opinion or correct or wrong, then it's the correct. How to justify your answer? How are you going to give the advice? This is my points, which is what kind of expenses can deducted when computing the business income. Then it's the incurred for the production of income other than capital nature. Then here, accordingly, this is the application part of it. Accordingly, in order to claim the expense as a deductible expense, it shall be incurred for the purpose of earning profits or income that was satisfied, and it should be sufficiently connected to the carrying on a business or investment that's done. Further, it should not be capital nature. What is the capital nature? The benefit is going more than 12 months period. Now, application of the provision of the Inland Revenue Act to the given scenario. As per information provided, the lump sum payment was paid to protect the existing market share by the competition from the retired director. Hence, by nature, the benefit of the expense long lasting more than 12 months period. Therefore, this is the capital nature. And application of the case law provision, and further, as per the decided case law of the Associated Portman Cement Manufacturers Limited versus Clear, it was held that the expense relating to sum of money paid to a retired director in consideration of a restrictive covenant, like a same scenario. Then a covenant not to compete with the company had to be considered as a capital nature expenditure. Same thing we can take. The payment to the payment to that director we have to shall be considered as a once and for all payment to bring into existence of the advantage of the enduring benefit of the company. Then the conclusion, under both Inland Revenue Act and the case law provision, lump sum payment is a capital nature, hence shall not be deductible. Anyway, the Assistant Commissioner's point is. That is for 5 marks. And the next one, which is the company, the second one, Roman 2, 3 marks and the 2 marks. Then second one, the company is not satisfied with the assessment issued by the Assistant Commissioner. Anyway, all of us not satisfied with the assessments issued by the Assistant Commissioners. We have to go for further steps and outline the next steps, settlement procedure that will be available to the company to follow. You are expected to cover the relevant appeal process at different levels and the timelines of each steps. Now, Laman, again, highly theoretically administrative provision. If you have open book referential material, which is your act, and from the act, You can refer these things and quickly you can write. It asks in two perspectives. What is the next level which you can go and what is the timeline to go? First thing, what are you all going to do if you all received the assessment, the administrative review, the section 139? In that, what you are going to do, we are going to review our decision by the Commissioner General of Inland Revenue. Simply appeal to the Commissioner General of Inland Revenue or a tax administrative review. In that situation, that's the first thing under section 139. What's the time period? Time period is 30 days from the date of the serving of the notice of the assessment. That's all for you to write. Secondly, we can go for TAC, the Tax Appeals Commission. Then for go for Tax Appeals Commission, you need to look at for two criteria. What are the two? Anyway, go for Tax Appeals Commission under section 140 and the Tax Appeals Commission Act. Then there are one particular condition to be satisfied, that is definitely being a taxpayer who received the assessment, you have to appeal to the CGIR. අනිවාර්යෙන්ම appeal එක දාලා තිබිය යුතුමයි. Appeal to the CGIR. Then at which 2 points you can go for the Tax Appeals Commission. 1 point, you have made the appeal for tax administrative review and it has reviewed and you have received the determination from the Commissioner General of Inland Revenue. And what the situation? I'm not like, I have dislike to the opinion given by the Commissioner General of Inland Revenue. I have not agreed with the opinion given by the Commissioner General of Inland Revenue, then I can go for TAC, the Tax Appeals Commission. And the second scenario, I have appealed to the Commissioner General of Inland Revenue for the review my decision, but within the expire from the date of that appeal, then the expiration of the 7 months, I have not received the decision. By quoting that, I can go for Tax Appeals Commission. Then that's the timeline, 2 timelines for Tax Appeal Commission in 2 stages. And the third one, after that, you have to go for the Court of Appeal. Then in the Court of Appeal, we have 90 days requirement on that with the Commissioner General's determination. Either party, the Court of Appeal, now from the Tax Appeal Commission, maybe I'm the taxpayer, maybe I have received the favorable decision. And therefore, unfavorable party is the CGIR, then they can go for Court of Appeal. If I have not received the good decision, then I can go for Court of Appeal. Either party agrees with the decision of the Tax Appeal Commission, they can go for the Court of Appeal. Then that's the 3 marks, the 3 points asked from your, in the higher scale, you can go for the Supreme Court. Then let me come to this. To take the 3 marks answer in here, then I'm not going to comment again. Relevant appeal process at different levels and the timeline. Request to review the taxpayer decision with the CGIR, Tax Administrative Review, Section 139. Timeline, very simply, within 30 days from the serving the notice of assessment shall make a request to CGIR in writing to the review the decision. Then please go for these areas, because if these things tested, it's good for you all, because you can take the advantage of the open book referential material. Then here, the Tax Appeals Commission, Section 140, if the company agreed by the decision of administrative review or after period of 7 months has lapsed, that's the finality of the assessment. Now this is the period. Since the request for administrative review was made, the company may appeal to the TAC with the copy of the CGIR within 30 days of the CGIR's determination or within 30 days from the date on which the period of 7-month tax. Or the first condition, you have to appeal to the CGIR. After you are getting decision within 30 days, you have to appeal to the Tax Appeal Commission, and the rest of the thing after completing of the 7 months, immediately within 30 days, you can appeal to the Tax Appeal Commission. Then, since the request for an administrative review was made, that's compulsory requirement. And the third one is the appeal to Court of Appeal, Section 144. If either party, either CGIR, either taxpayer, dissatisfied with the decision of the Tax Appeals Commission, the relevant party may file a notice of appeal with the Court of Appeal with the copy to the other party to help them to further procedures. Then what's the timeline? Is proceeding before the tax within the month after being notified of the decision upon the period of 90 days having lapsed since the request for appeal to the Tax Appeal Commission was made and no response to the request for the appeal has been received from the Tax Appeals Commission. Now, for like in the which is on the Tax Appeal Commission to put the appeal from the CGIR, then for this one also there is if you have not received any response from the Tax Appeal Commission within 90 days from your request, you can go for the appeal court. And if not, if you have received the decision, aggrieved either party, then you all can go for the within a month after being notified decision, you can go for the appeal court. That is on for 3 marks. Highly theoretical. It's rather, it's an application, but you can take the benefit of your act. That's for the 3 marks. And the next 2 marks, again, really easy from your side, which is the outline the applicability of the penalty and interest on the late installment payments. Then what late installment payments? I'm coming to second bullet. Further, the Assistant Commissioner noted that 2 quarterly installment payments were not made by the due dates. Further, due dates further statement of estimated tax payable set filed by the company. What are the due dates of the payment of the tax for year of assessment 22-23? Is the first installment on or before 15 February 2022. On the same date, you have to file your original set, the statement of estimated tax return. And the second one, 15 November 2022. And the third one, which is on the 15th February. And the fourth one is the 15th May of the next or a subsequent year of assessment. Okay. First done. Second done. But 2 quarterly installment payment. If I have guessed, if the last 2, if they have not done. Anyway, what's the penalty provision and the interest? Non-payment of the quarterly installment payments. Is that penalty applying if I have not made the payment on the 15th February? If the penalty applying to me is applying to me on the midnight of the 15th? No. They have given 14 days a grace period for taxpayer. Then after that 14 days, if you have not paid, then the 10% tax will be applicable. And the interest, for interest that 14% grace period is not applicable. Then from the day one, which you have default, to be default, from that, you have to pay 1.5% on monthly basis computed. Okay. Then that is for 2 marks on this. Let me come to a simple answer, which is in here. Outline the applicability of the penalty and this, which is as per information provided, 2 quarterly installment payment is given. The action verb is outlined. Then without wasting your time, quickly write your answers. Then it's the quarterly installment payments were not made by PTL. Accordingly, following penalty provisions will be applicable. in section 179, subsection 2, in that subsection 1, it's for final income tax or on assessment payments, and this is for partly installment payments. Sorry. A person who fails to pay all or part of an installment required under this act within 14 days of the due date for the installment shall be liable to a penalty equivalent to 10% of the amount and tax due but not paid. Therefore, PTL liable to pay this penalty plus interest, which is interest applicable on late payment on partly installment payments, particular section 157 and 59, which it has given the calculation and what is the rate. Then the interest rate for late payment shall be 1.5%, 1.5% per month or part month. It's a computed monthly. This is on the writing part. It's actually students can obtain the marks. It's a good from the side of the students. Then it's the completion of the halfway of the paper. If you have any questions on resident tax administration questions, you all can ask. If not, I can go for the next question and give the option to ask any question after the discussion. What's the good thing? If you have the questions on this 50 marks, then I can help. If not, we will complete the entire paper and go for the questions. Anything to clarify? Cement company and clear. Thank you. Then I think we will go for next part and we will come to the answering of your questions. Then let me start with the question 1. 1 and 2, I will come in the methodological order. Then here, which is on the question 1. Section 1, question 1. Then, which is non-resident and international taxation. In the paper, last part of the paper, as the annexures, the particular articles given. In this question, 2 double taxation treaties, which it's a small part of the 2 double taxation treaties tested. The major one is the Sri Lanka and Singapore, and yeah, there was a Finland one. Yeah, this is the annexure 2 in between the Finland and the Sri Lanka double taxation treaty. It's only the Article 16 directives, very small paragraph. It's not lengthy. Then that's the 2 double taxation treaties. The extracts of the double taxation treaties provided, and this is the question. Then here, let me come to the requirement first. It's the 18 marks first we will do, and we will come to rest of the part. And again, for this one also, I'm not going for very detailed answers, but I need to go for double taxation treaties and how it has tested and how are you going to answer, how to extract the points from the question. That's I need to look at. I'm not going to for lengthy detailed answer. Then here required discuss this your action verb. More action verbs are there. Then you have to discuss whether TTS, who is the TTS we need to look at, is required to pay income tax in Sri Lanka for year of assessment 23, 22, 23. TTS required to pay income tax in Sri Lanka for 22, 23. Okay, and compute the income tax liability. Now, always, that's why I'm telling, read the requirement. No, if it is your Patrice, I think it's good. Then read the requirement, then you can understand. In the first part, it's asking on the whether liable to pay income tax or not. Second part is asking compute the income tax liability. Then it's coming to a radar to your brain. Okay, in somehow there is income tax liability. If not, I cannot do the second part. Then that's two requirements, and you have to align your answer like this. Support your answer seated in statutory provisions of the Inland Revenue Act number 24 of 2017 as amended, and the double taxation agreement between Sri Lanka and Singapore. Now, obviously, Lamai, now what's the next alarm coming to your mind? When writing or computing this 13 marks, are you going to aware on the Finland double taxation treaty? No. Then only thing you have to have the Sri Lanka and Singapore. Secondly, your answer should include an analysis of the following. Now, three bullets given. One is permanent establishment exposure to TTS in Sri Lanka. Secondly, whether the full contract value that includes income from the following is liable to tax in Sri Lanka, supply of hardware, software, and supporting services. Third one, applicability of exemption for IT and enabling services, the TTS. Very is a very patriarchal, and when it comes to this IT industry, highly hot topic. And again, if I have taken this question, if you have practiced the past papers, I'm always telling, if you have practiced the past papers, then you can take the marks, because this kind of the questions, not the entire question, but at least a small part, it has, if you have done the past papers, then it's a very, very help for you at the examination. Then in this one, it's through the three bullet points, it has given how you are going to answer. Then again, to obtain the 13 mark, it's very easy for you all. And don't forget, when it answering this income tax, discuss the TTS is required to pay income tax in Sri Lanka, then maybe what I felt, maybe then after doing this bullet 1, 2, 3, you may be forget to go for compute income tax liability. Then therefore, please keep in mind it for 13 marks, including discussion and the computation. Let me complete the 13 marks in the Roman one first, and I will come to the balance. Come to the question, which is part A of the question 1, which is TTS. I'll use the small name. TTS is a listed company incorporated in Singapore. Very, very important. At the starting point, it's really important. TTS is a listed company. The application of the treaty, cancellation of the treaty benefits, this word listing is very important for us. The principal activity of the company is software development services. Again, very important. Which is the TTL is a company incorporated in Sri Lanka. Is it Triton Technology Lanka Private Limited? Then is a TTL is a company incorporated in Sri Lanka. Now let me take this too. TTS is a listed company incorporated in Singapore. Is a listed incorporated in Singapore resident or non-resident? Non-resident company. If there is a non-resident person in here, non-resident company, then under section 4, assessable income, what's the income shall be liable to pay tax in Sri Lanka? The assessable income arising from employment, business, investment, or other. When it comes to company employment income not applicable, other income is in the scenario basis. Then therefore, the assessable income from business or investment shall liable to pay tax in Sri Lanka. Then when it comes to the tax liability, then we need to look at under section 73, what is the source of payment? Then when it comes to source of payment under section 73, I need to combine with section 75. The application of the double taxation agreement or a mutual administrative agreements. In that, then we need to look at whether there is a double taxation treaty. Of course, there is a double taxation treaty. Now the question, can we apply the double taxation treaty? Section 75, 3 and 4, we need to refer. Since this is a listed company, yes, we can apply the double taxation treaty because if the 50% or more of the company, which is in the non-resident company, 50% or more shares is with the another nationals, that means another individuals, then you cannot apply the double taxation treaty. But that treaty, the cancellation provision shall not be applicable if that company is a listed company. The section 75 is one of the very, very important provision. In that 75, 2, 3, 4 are very important. Then here, that's on the by reading the question which I have taken. Let me again see this. Okay. Then here, which is the being a non-resident company. Now these things, it's when reading the question, these things came to my mind. Being a resident company is a TTL, you know, it's the world income shall pay tax in Sri Lanka. Then TTL, what's the position of TTL? Is a company incorporated in Sri Lanka and it is an associated company of TTS. One of, again, important thing. TT Holding OYJ TTH, another company. TTH is a company incorporated and listed in Finland. This one also listed company in Finland. We will look at what's the relationship of that company. And it is the ultimate parent company of the group. It's the ultimate parent company of the group. TTH owns 100% of the shares, both TTS and TTL. That's the relationship. Then if I be in a TTS and TTL, the wholly owned subsidiaries of the TTH. Now, this on the first paragraph, just to provide the information of the residents and the non-resident status and the principal business activity of three organized, not the three, yeah, all three. Then the next paragraph, TTS has entered into contract with customers in Sri Lanka. Who has entered with the contract with the customers of Sri Lanka? TTS. Resident company or non-resident company? Non-resident company. Entered with contract with customers in Sri Lanka for the provision of what? For the provision of software and related services. Okay. The structure of the arrangement or agreement herein is as follows. Then what's the first bullet? That the tri-party agreement will be entered into between the customer, TTS and TTL. This so-called two companies. Here, then customer, non-resident company and the resident company. For the provision of three things: hardware, software, and related services. This is on the three-party agreement, the particular areas of the services. Then wherein the customer has to claim on both TTS and TTL with regard to the contractual obligation of the contract. Then customer, so lucky, they can have the claim either from the TTS, either from the TTL. It's on board. Then why? As per agreement, maybe hardware provider is one, software is one, related service one, like that. Then the next one. Then in that the context, that TTL and TTS, they oblige for the customers whatever the services that they are providing. From the second bullet, per the agreement entered between the parties, TTS, which is a non-resident company, TTS will supply the necessary hardware and software. What is the supply of TTS? Hardware and software. And while TTL will provide the support services in relation to each software. This is the next thing. Second paragraph, explaining principal business activities of each two companies separately. In that, TTS hardware and software, TTL support services in relation to this hardware and software. And the third one, per the agreement, TTS will retain the title. There is a tri-party agreement in that TTS will retain the title and interest. Retain the title and interest to all the intellectual property rights in all its product, and the customer will only granted the right to use the software in his or her business. Only the right. Copyright is with me. The royalty, whatever, it's with me. I'm not giving that to you. You can use the right. All the control is with me. And this paragraph also very important. All the things important. And the fourth point, the customer will place the order with TTS. කාටද order එක දාන්නේ? TTS. This is the arrangement of the activity. The customer will place the order with TTS. One. And TTS will raise an invoice to the customer for the total fee. Now, question. Can they put an invoice for the total fee? Is that total fee eligible for them? The thing is, come to again the first paragraph. According to the three-party agreement, hardware and software, second bullet, hardware and software will be provided by TTS. They can invoice for their part. But the support service is provided by whom? It's the TTL. That's their main income. Then what's the arrangement in between these two companies? While TTS invoicing for entire package, then subsequently pursuant to an agreement between TTS and TTL, TTS will reimburse TTL for the services provided by TTL. The reimbursement will be provided. That means reimbursement, what they actually incurred. Again, it may be reimbursed with the arrangements. The amount payable by TTS to TTL will be determined based on the transfer pricing methodology of the group. Very arm's length. Then not the actual figure, but based on the arm's length price. And if I have taken this support service from a third party, what's the price? They are going to charge to me. Then the same way they are going. Then the next paragraph. In that, which is the software provided by TTS is developed in Singapore, and the employees of TTL do not get involved in the development of this software. What is that software provided by whom? TTS. Then the TTL, even they have done the support services, no employee has involved in this. Why this information given? Actually for you to take the benefit out of to identification of the permanent establishment exposure, which is given in the requirement. Then TTL provides support services to customers of TTS in Sri Lanka. TTL, the local company or resident company, provides support services to customers of TTS in Sri Lanka. I will put this as read. And TTL's revenue is derived by wholly from the provisions of such services. And I will keep this as read. I need these two sentences to confirm the PE exposure. Negotiation and conclusion of contractual terms are done by TTS directly from Singapore. Upon finalizing the contracts, TTS supplies the software and hardware. Upon finalizing the contracts, TTS supplies the software and hardware directly from Singapore, and the employees of TTS do not visit Sri Lanka to project services. Again, very important. Now, details pertaining to contract entered into the TTS for year of assessment 22-23 are as follows. The breakup of the elements are indicated in the respective agreement with the customers. This income was entered evenly throughout the year. It's equally attributed. Why? That part has given. For first 6 months, you had to apply a 1 rate. Next 6 months, you had to apply a 1 rate. Then it has fairly given. The income was earned evenly throughout the year. Then value of hardware. This is the total contract value. You have to remember this. Where is the colors? Okay. Then value of hardware. It's a 20% of the contract value. How to supply? Supply from Singapore and ownership passes outside Sri Lanka, totally an offshore part of it. Value of software, 70% of contract value from US dollar 12 million, 70%. Then it's the supply from Singapore. However, it is operational only once the support services are provided by the TTL. Just supplying of the which is software, you cannot operation it without the help of TTL. It's combined. Then software to operate from Sri Lanka, TTL has to do the support services. Then value of support services is the 10% of the contract value. From 12 million, it's 10%. Then closely connected to supply of software. These two together, it's coming closely connected to the supply of software. Now you have to think, now without TTL services, this 70% and 10% cannot take from the entire contract value. Okay. Now the last paragraph, in the case of the supply of hardware and software, TTS maintains a profit margin of 35%. In the case of supply of hardware and software, TTS maintains a profit margin of 35%. This is that, which is on the hardware and software, but actually software part is applicable for us. In the case of support services, TTS pays TTL for the support services at a cost plus 75% markup. That was earlier also highlighted as given at the arm's length pricing, they are providing within the group agreed arm's length price, the transfer pricing method of the group. Then it's a 7.5%. And the margins retained by TTS are lower than the margins earned in the supply of hardware and software. The total cost incurred by TTL in relation to the provisions of support service is in 22-23 was US dollar 925. This is totally for your calculation perspective. Now, assume that the exchange rate is US dollar 1 is LKR 320. Extracts of the article 5712 and the protocol of the detail. This is the first time the protocol has tested. Then the protocol of the double tax agreement between Sri Lanka and Singapore are given in the Annexure 1 for your reference. Now, let me counter the question again. Discuss whether TTS is required to pay income tax in Sri Lanka. Let me complete that. Your answer should include the analysis of the following. This is on the first part. Permanent establishment exposure to TTS in Sri Lanka. Let me come to this. Then let me come to one by one. This is a resident company. Resident company, if the resident company under section 69 subparagraph 4, then being a resident company, sorry, non-resident company, I'm really sorry. This is non-resident company. And in the non-resident company, it's incorporated outside Sri Lanka under section 69. And being a non-resident company, assessable income arising in not derived from Sri Lanka, you have to pay tax. In that, being a company, we need to look at are they earning a business income? To check that, are they earning a business income, we have to go for what? Permanent establishment. Without having a permanent establishment, you cannot tax the company with reference to their business income. You have to look at the income and expenses attributable to the permanent establishment. Now, therefore, it's in the Article 7 of the Sri Lanka and Singapore Treaty. We need to go for what's the permanent establishment. Now, let me come to that. If I need to go for treaty, then I have the treaty. I will go for that anyway. Then at least it's familiarized to you all, know. Then here, which is this is Sri Lanka and Singapore Treaty, I need to come for Article 5. Now I will analyze with this. So, in the Article 5, permanent establishment, this is first page I will show you. This is on the Sri Lanka and Singapore Double Taxation Treaty. In that, I need to go for Article 5. In the Article 5, what it has mentioned, I will analyze these articles for given scenario. Then it's to be the permanent establishment. Permanent establishment means a fixed place of business. Now my question in here, I'm looking for TTS, a non-resident company. This TTS, is that company has a fixed place of business in Sri Lanka? Answer is no. And the second one, permanent establishment includes specifically place of management, branch and office, factory, workshop, and the things. Anything relevant to us? No. Then for PE article, the subparagraph 1 and subparagraph 2, not applicable. Coming to the paper again. In the paper, I'm coming to the requirement, which is permanent establishment exposure to TTS. I'm analyzing that using the treaty. Now let me come to that, which is in the question 1. Don't I have? I think. Here. I think where is my answer? No, let me just for 1 minute to stop share, and I need to anyway, I will give the 5 minutes break to you because my answer one part is not there. I need to check. Then give me 5 minutes and I will stop share and let me take this and let me come back within 5 minutes. Okay, I can start. I'm sorry. The answer is there. Then 5 minutes has not gone, but let me again share the things to you. This is that. Then I also confused what happened to the answer. Then here, uh, which is in the question 3. Sorry, it's the here, where's the thing? Okay. Then, which is analyzing of the scenario, which is on the question 1, analysis of the information of the scenario. I have discussed with you. That's why it's make it as the empty. Then, which is here, the permanent establishment exposure, and to look at whether it's liable to pay tax in Sri Lanka and how. Then whether TTS is required to pay income tax in Sri Lanka. This is the answer format, the introduction under the 3 particular bullet points. The chargeability of non-resident person, then under section 4b, non-resident person shall pay tax on the assessable income arising in non-derived. TTS is a non-resident, then resident or non-resident, then non-resident. Why it's incorporated in Singapore? What is the income arising from Sri Lanka? We need to look at. Then what is the application? What's the tax application? Are we going for Inland Revenue Act? Are we going for double taxation treaty? Since there is a DTA, shall apply the DTA provision, section 75, subparagraph 2. Can TTS apply the DTA provision? The section 75, 3 and 4. Then let me come to this one also. This is extract from the Act. Then where a double taxation agreement provides that any income from a Sri Lankan source is exempt or excluded from tax, or the application of the agreement, the important thing is there, result in the reducing in the rate of Sri Lanka tax, the benefit of that exemption, exclusion, or reduction shall not be available to a body that the purpose of the agreement is a resident of the other contracting state where 50% or more of the underlying ownership or control of that body is held by an individual or individuals who are not resident of that other contracting state. Then we don't know with reference to the TTS. Who is the main shareholder, Lamai? The main shareholder is TTH. The name is TTH. The main shareholder is the TTH. What is the country the TTH has incorporated? Finland. Then, now 100% ownership of TSS goes to a Finland company. Then therefore, what has happened, if the TTS has not listed, can you apply the Sri Lanka and Singapore treaty for these calculations, for these explanations? No. Then under section 75 subparagraph 4, it has given what is, however, above shall not apply if the resident of the other contracting state is a company listed on the stock exchange of that other contracting state. That's why we are good. We can apply the provisions of the double taxation treaty because in the question very clearly given, TTS is listed and the first paragraph of the question given, the shareholding structure of the TTS and the TTL both, it's 100%, it's only on subsidiaries of the TTH. Then since it's listed, you all can apply the DTA provision. Since the TTS is listed entity, the provisions of the DTA shall be applicable. I link to this yellow colored thing. What is the income arising from Sri Lanka? The analysis of the PE exposure we have to go. Why? To tax business income, there should be permanent establishment. I think you are so familiarized with these things. For us to tax the business income, there should be a permanent establishment. Then we need to look at PE exposure as per the requirement of the question. permanent establishment. Now, in the previous, we have came across this, which is the no fixed place of business, nothing, no branch office, those things are nothing. Then I'm coming to here, application of the Article 5 of the permanent establishment. Article 5, subparagraph 1 and 2, fixed place of business, we don't have. Subparagraph 3, which is a service PE or activities like a construction, the supervising activities with the employees. Question very clearly given, none of the employees of the TTS know they came into Sri Lanka. Then even this, which is on this paragraph in the PE, we cannot apply, which is the paragraph 3, the term permanent establishment also encompasses a building site, a construction, assembly or installation project, a drilling rig or ship used for the exploration or develop of the natural resources, including supervisory activities in connection therewith, but only such site, project or activity lasts more than within the 12 months period, which is in the 183 days. There is nothing. And the furnishing of services with the supervisory activities of the employees, that also no there. Then TTS, no employees came into Sri Lanka, everything done by TTL, then we cannot apply paragraph, article 5, subparagraph 3A or B. No. Now we have a question. How they are going to become a permanent establishment. Now, which is para 3 and come to subparagraph 5. In subparagraph 5 or 4, it's a subparagraph 5. The relationship of the dependent agent other than the independent agent. Now there are enough information given in the question for you to determine that TTL acting as a dependent agent to TTS and the acts on behalf of the TTL to TTS. TTS earned income from Sri Lanka. Now you have to identify what kind of the income that TTL, TTS will be arise or derived from Sri Lanka. Come to this, notwithstanding the provisions of subparagraph 1 and 2 that we have discussed, where the person other than agent of the independent state, other than the agent of the independent status, to whom paragraph 7 applies, is acting in a contracting state on behalf of the enterprise of the other contracting state and has an habitually exercised in that contracting state an authority to conclude contracts in the name of the enterprise, that enterprise shall be deemed to have a permanent establishment in that state in respect of any activity which that person undertaken for that enterprise. Let me come to here, irrespective of having a fixed place, anything. Now tell me in the question, is that provide information for you that TTL conclude contracts on behalf of TTS? Yes. In the first paragraph, in the tri-party agreement, it has very clearly given the customers can take the claims from the TTL as well as the TTS. And the TTL doing all the activities on behalf of TTS. And legally, TTL and TTS, the associated person. And the TTL main income, wholly income is from what? Providing support services on behalf of whom? On behalf of the TTS. And very important, this chart in here, what it has provided, the supplied from Singapore, however, it is operational only once the support services are provided by TTL and support services closely connected to the supply of software. These are interrelated. Without having support service, no value of the software. Then therefore, what has happened, TTL doing entire the business model to support what TTS. Therefore, on behalf of TTS, TTL acting on behalf of the dependent agent, and therefore there is a deemed PE provision which is considering as the dependent agent permanent establishment by the side of the TTS. Okay, then come to here, which is the permanent establishment exposure, subpara 5, dependent agent relationship. Yes, we have. Why? What's the reason? Let me come to analyze. As per the DTA, if there is a person other than independent agent acting on behalf of the enterprise, this totally taken from the treaty provision, that particular wording, who habitually exercise authority to conclude contracts in the name of the enterprise shall be deemed to have PE, then unless activities carried out the ancillary and the preparation in nature. No ancillary, no preparation, is total business module depend on the TTL. Then analysis of the tri-party agreement to confirm that yes, this agency PE, which is on the dependent agency PE. Details from scenario. TTL associated person with TTS. A tri-party agreement will be entered into between customer, TTS and TTL. Third one, customers has claimed on both TTS and TTL as per the contractual obligation, taking obligation on behalf of TTS. Why? I'm not the person who developed the software. Then why I'm taking responsibility towards this? Because I'm representing who? TTS. Then the TTL provides support services in relation to software supplied by TTS, acting on behalf of TTS, and sole income generated through such support services. Fifth one, the total income received to TTS, including the income attributable to services made by TTL. Therefore, the income for support services which received from Sri Lanka to TTS wholly received only due to activities of TTL. The software developed, the supplier developed software and the supporting services will combine each other. Then the total income coming to TTL, one particular person, it's only due to TTL. Therefore, TTL acting as a dependent agent to TTS. Lamai, these all the things, points I have taken from the given scenario. And I'm expecting the same approach from your end. This is for you to apply. It's an application you have to do. Just you have wrote, it's a TTS is a non-resident company. Income arising in or derived from Sri Lanka shall be taxed. Then it's not getting marks. Then you have to apply to given scenario and take the points out, and to help that points for you to conclude your answer in a solid manner. Then here, the next, it asking on the next part. Now PE exposure we have completed. Now I need to come for next bullet. Whether full contract value that includes income from the following is liable to tax in Sri Lanka. Supply of hardware, genuinely it's not liable. It's very clearly you can identify it's a supply from Singapore and ownership passes outside Sri Lanka. And in this paragraph, it's very clearly given, which is on here, on hardware, where it was. It has mentioned the total contract entered into Singapore and invoice and the things. Yeah, there was a thing I couldn't find now. Then there was a thing that a total contract entered into Singapore and the supplying totally from the Singapore. Yeah, customers will place the order with TTS. TTS will raise an invoice to the customer, and pursuant to the agreement, TTS and TTL, it will transfer then all the the particular hardware thing, it has developed in Singapore, and it will all the rights and the ownership is with the TTS. Then here, which is it's not liable for income tax because it's the not the income arising in or derived from Sri Lanka. It's the outside Sri Lanka that particular transaction or that particular activity has been taken place. And the next thing in the question, which is on supply of software and supply of support services, definitely it's attributable to the permanent establishment because it's everything done by the TTL. Then both these activities shall be liable to pay tax in Sri Lanka. Let me come to that too also, which is income tax liability in Sri Lanka for each agreement as per the contract. Supply of hardware not liable to pay tax in Sri Lanka because developed in Singapore. Negotiation and conclusion of contractual terms done by TTS directly from Singapore. Therefore, no income arising nor derived from Sri Lanka. This same kind of the things, it was tested in the past papers. And please practice the past papers. It's the key success factor for you to pass. Please practice. Now it's a high time. Please practice the question. It helps for you to pass. And supply of software liable to pay income tax in Sri Lanka because all supporting services related to fixing operation of software provided in Sri Lanka, therefore attributable to PE. Support services definitely is a part of the income attributable to PE. The success of the supply of software totally depend on this, and the full payment received to the TTS and on same as per the, which is agreements, then the which is arm's length agreement transferred to TTL. Therefore, income and direct cost both shall be recognized with reference to that. Means it can have a permanent establishment. We have to recognize income and the expenses attributable to permanent establishment. And then in here, one side it's coming as income, other side is coming as the expense. Okay. Then this is on the second bullet. And next, third bullet, applicability of the exemptions of IT enabling services. Eකට enna kaling, let me complete the computation and then come to that. Then now in here, total that analysis of the scenario and analysis of the PE exposure and analysis of the liability part, which it has completed. Then therefore, let me come to it's a question one. One is blinking. Yeah, let me come to this. What has happened? Okay. Then here, which is, let me take the computation because this is the PE, which is TTS, and the income tax computation, including the remittance tax on Sri Lankan operations, and for the year of assessment 22-23. Then let me come to the question and take the facts from here. This is the chart. Then we have the total contract value, which is 12 million. Value of hardware, this is not applicable for us. We have analyzed. Value of software is 70% of the contract value. Then from the 12 million, 70% you have to take 8.4 million. Then the value of support services, it's a 1.2 million of the US dollars. Now come to the second thing. In the case of the supply of hardware and software, it's talking about these two. TTS maintains a profit margin of 35%. Now, Lamai, this one you have to take very carefully. මෙතන දෙනවා අපිට contract එකකින් 70%. That's my revenue from the supply of software by TTS. Revenue is the US dollar 12 million into 70%, 8.4. Can we take that 8.4 as it is? We have a profit margin only 35. Then from 100, if I have equivalently 70% to 100, then the 65% is my cost. Then I cannot take the 100 as my which is my revenue, then I need to consider revenue less cost. The cost 65% not given, but 35% margin has given. Then therefore, are you going to take this 12 million US dollar into 70% as your revenue? No. You have to take from that 8.4, that from my revenue, it's given profit margin. From that, you need to take 35%, that as the net income from the value of software. Let me come to here. Then value of hardware, which is not liable, we have concluded that value of software is a US dollar 12 million at 70%. This is the thing. But this is not my, the margin, this is not my net revenue of the software. Profit margin maintained for software and the hardware, but hardware not applicable. 35% of contract value. From this, you have to take the 35%. Done. And that is my gain, or that is my profit, not this 8.4. That's the 1 point in here. And the secondly, when it comes to value of support services, 10% of the contract value, then is the 1.2 million. Here, it's 1.2 million, so 10%. Then the corresponding cost, in the case of support services, TTS pays TTL. Now, we have recognized the income and we have to recognize the expense. TTS pays TTL for the support service at a cost plus 7.5% of markup, not the margin. You have to cost plus 7.5. Now, what's the cost? It has given the total cost incurred by TTL in relation to the provisions of support services. Year of assessment 22-23 US dollar 925,000, 925,000 plus 7.5% upon that. It's my total cost with reference to a value of support services. Let me come to that one, which is here. Value of support services. Now this is my total income. You take this and the less expenditure amount transferred to TTL on behalf of support service. This is how it's 925 plus 7.5% markup on 925. Then this is the answer after taking this into consideration. And this is my net profit, assessable business income, taxable income. The all equal to this because all the expenses are allowable deduction, nothing to disallow. And to take the accounting profit before tax and do the things, it's not necessary. Then here, the net profit is this, net profit before tax. Then which is the total net profit, let me add before tax. And assessable business income, and we don't have any interest or anything, then the taxable income is this. And the tax liability from this, let me take, I have to divide this into 2, which is by dividing this. This one divided by 2, then it's a 1,752,000 or something. Then for that, it's a 24%. Okay, this divided by 2 into 24% for the first 6 months. Before coming to the rate, let me come to IT exemption. Here in the IT exemption, now applicability of exemption. Tax rate, but I forgot that. Then here, applicability of the exemption of IT enabling services to TTS. Lamai, that gazette notification on the income tax, which was abolished now, which is from 23-24 onwards abolished. Then up to 22-23, what's the gazette notification provided? IT and software development and IT enabling services conducted in Sri Lanka, the exemption is applicable. Now, if I have taken the gazette, this is the gazette notification. Sorry, this is for value-added tax, but in the same, but I need to take this one. The software developed in Sri Lanka, and this activity is It's all the things. It should be, it's a software developed in Sri Lanka. Now in our case, what it has happened is that software developed in Sri Lanka or software developed Singapore. It's the software developed in the Singapore. Now, can we apply the exemption? No, we cannot apply the exemption. Therefore, the normal tax rate for the first 6 months, 24%, and the standard tax rate for next 6 months, the 30% on the taxable income you have to apply. Now, let me come to that explanation also, which is here, the application of the exemption, IT and IT-enabled services to TTS. As per the Gazette, the software development services in Sri Lanka and adoption, upgrading, enhancement, implementation and similar services related to any type of software developed in Sri Lanka exempted from tax. In the given agreement, the software is developed and supplied from Singapore. Therefore, the exemption will not be applied and the standard rate of 24% will apply for the first 6 months, and for the balance 6 months, 30% is applicable. After that, it's continued to under the 30%. Okay, then accordingly, we are applying this thing for first 6 months, 24%, and the balance 6 months, which is the 30%. This is my total tax liability. Now it's easy. From this, you have to compute the remittance tax. Then when it comes to computation of the remittance tax, this is my, it's equal to my profit before tax. This is my profit before tax. This is my tax liability. Then I need to take the profit after tax. This minus this one is my profit after tax. It is this, which is a 2,296,306. For this, I have to apply the 14 by what I'm applying the fraction of this, because after paying 14% tax, I can remit. Then I need to look at what's the inclusive tax which I have to pay. Then this into 14 is a 282,003. This is my tax liability, the both of these two. Then if I have taken this one, then I have to remit here, which is, I have to remit from this, after deducting this, if I have applied 14% on this one, then it's the same answer will be comes, it's a 282. Then for net one, I have to pay, because we have to pay the tax and remit the balance. Okay. Then this is on that calculation, all included in the US dollars, but we have to go with our the presentation currency. Then it's the LKR. Then here we need to convert into 320. This is my tax liability, total tax liability in LKR. This is the question, and this also included in the 13 marks. For all these things, it's 13 marks. Then for 13 marks, 1.8 minutes, you have to conclude this within 23.4. That means at least within 25 minutes, you have to complete this 13 marks. Then the Roman 2, which is for 5 marks, assess the requirement of the, this is what you have to do, assess the requirement for the customers to withhold tax when remitting the payment in relation to software to TTS in Singapore. Now what's happening? We are supplying, I'm TTS. I'm supplying softwares to you. Then you are making, and I'm invoicing you. You are making payment to me, the outward remittance. Then on this outward remittance on behalf of the supplying of software, that is my principal business activity. Then the
what's the application of the withholding taxes? Anyway, for this, we have to look at what's the application provisions of the Inland Revenue Act, what's the application of the DTA. What's the next thing? Support your answers. 18 is statutory provisions of the Inland Revenue Act and any relief that may be invoked pursuant to the DTA. Okay. Now we need to look at the application and we need to look at do we have any relief with reference to double taxation treaty? Now, what's the applicable withholding tax rate according to the provisions of the Inland Revenue Act? It's a 14%. Then this is coming under, we are using the right. It's very clearly given in the question. The paragraph bullets 2 or 3. Third one, per the agreement, TTS will retain the title and interest to all the intellectual property rights in all its products, and the customers will only be granted the right to use the software. It's kind of a royalty, and the intellectual property rights are with me. Then for that royalty, then it's a remitting to the outside Sri Lanka, then the applicable withholding tax rate is a 14% as per Inland Revenue Act. Done. Now the question is, what's the application as per the provisions of the DTA? Then in the DTA, the examiner is asking in the question, any relief that may be invoked pursuant to DTA. Now I need to go for DTA and I need to go for provision of the royalty. Let me come to DTA and let me come to the provision of the royalty. Where it is, I think it's 12 or 13, then it's 12. It's a royalties. Then here what it has mentioned. Royalties arising in the contracting state and paid to a resident of other contracting state may be taxed in that other state. Done. What is the maximum tax rate which given in the Article 12 as per Sri Lanka and Singapore treaty is the not exceeding 10%, 0 to 10, whatever. Now come to the definition of the royalty. In the paragraph 3, what should be royalty? Now, the examiner is asking treaty involved. Can we take the relief from the treaty? Then we need to read little bit and we need to look at. Even in your paper, these articles were provided. The term royalties, as used in the article, means the payment of any kind received as a consideration for the use or the right to use any copyright, literacy, the artist, or scientific work, including cinematography, films or tape. Now the things are given here: television or radio broadcasting, and any patent, trademark, design or model plan, secret formula or process, or for the use of or the right to use industrial, commercial or scientific equipment, or for information concerning industrial, commercial or scientific experience. Now in the definition of the royalty, can you see the software rights? I don't see. Then here, it's even there is a provision in the Inland Revenue Act as a 14% tax rate. Then can we use the 14% since there is a double taxation treaty? No. We have to go for treaty. Now in the treaty and the royalty definition, it has not provided the software. Then where it has mentioned, then I need to go for protocol. In your paper it has given, but I am going for in the treaty. In the protocol, then in the format or protocol, it has given in the paragraph 3, what's the protocol? The government of the Democratic Socialist Republic of Sri Lanka and the government of the Republic of Singapore have agreed at the signing of the agreement for the avoidance of the double taxation and the prevention of fiscal evasion with respect to taxes on income, that the following provision shall form an integral part of the said agreement. Then in that, what's the statutory body, what's the shipping and air transport, all these things given. Come to third one. With reference to Article 12, royalties of the agreement, it is understood that in relation to payments for computer software, now it's given, okay? In relation to payment for computer software, such payments are royalties only. Royalty විදිහට consider කරන්නේ මොන වෙලාවෙදිද? Such payments are royalties only if the payments are made for the right to use and exploit the copyrights in the program. If I'm a customer of this TTS, then do I have the particular right? Then only if the payments are made for the right to use and exploit the copyright. Do I have the copyright? Do I have the, in this question, do I have the intellectual property right? No. Who has this? It has the TTS. I have right only to use, not that copyrights. Don't misunderstand. Huh? It's very clearly provided here, which is the, what's the right I have? It's the intellectual property rights in all the products and customers will only be granted the right to use the software, not the copyright. Then if it is so under royalty, under double taxation treaty, then we can take the exclusion of the, since this is not under the scope of royalty, it has given in the protocol, then therefore the not exceeding 10%, that particular party is not applicable. That's the one thing. That DTA relief. And the second one in the double taxation treaty, which is in the royalty, which is here. Fourth one, I think this is familiar to you. If the royalty is attributable to the permanent establishment, then it is going as a permanent establishment, and the whatever the tax paid on that, then that we can take as a tax credit under withholding tax, which is a non-final. Any withholding tax applicable to the permanent establishment derived due to PE, then it is non-final, then you can take the tax credit. Then separately that source we are not taking as the royalty, then under that scenario also, which is on the particular withholding tax may not be applicable. Come to that fourth point, the provision of subparagraph 1 and 2 in here shall not apply if the beneficial owner of the royalty being residents of the contracting estate carrying on a business. Yes, we are doing a business here. Business in the other contracting estate in which the royalty arises. Yes, it's arise through my computer software if arising through the permanent establishment situated therein. Yes, or performs in the other estate independent personal service is not applicable. Then, and the right of property in respect of which the royalty are paid is effectively connected to the such PE or fixed place. If such case, the provision of this is not applicable. Then therefore, in either situation, you can take the DTA relief, but it's more because we, in the both we can apply. One is, it's not under the definition of the royalty, since in the arrangement in the three-party agreement, and next one, which is, it's attributable to the PE. And therefore, for this one, which is the 5 marks, you have to write these things in the support your answer seating statutory provisions of the Inland Revenue Act, 14%. Any relief that may be invoked pursuant to DTA. DTA කියන්නේ tax rate කියන්නේ කියලා. It's telling any relief that may be invoked pursuant to the DTA. That's the 2 relief. Then since I have discussed with the DTA, I'm not coming to detailed answer. And that's for the 18 marks on non-resident and international taxation. Fairly, it's less, no, it's a detailer well organizedly given. Then you have a little bit think actually, and you have to think and you have to apply the things in the careful manner. If it is so, you can obtain the marks. And part B, it's again for 7 marks. In the part B, what you have to do, requirement, prepare a memorandum. Prepare a memorandum to whom? Prepare a memorandum for the next meeting with the Morris addressing the following. There is a person named Morris, not a company, individual. Then in that, what's your answer format is a memorandum. Then being in the memorandum, what they're asking, analyze whether Morris is liable to pay income tax in Sri Lanka. On the director fee, a year of assessment 22-23, referring to the Inland Revenue Act and the amendment, and the DTA between Sri Lanka and Finland. Assume Morris is a non-resident of Sri Lanka. Then it's a one time it has tested, which is on in the same question to identify resident, non-resident, and tax liability. It has tested in the part 1. Then part 2, the same concept is not testing, but different angle it has looked into. Second one, compute the increase in his monthly tax payable in January 2023 compared to December 2022, very easy. And explanation of whether or not it will be acceptable for your tax patrice to accept the engagement based on the suggestions made by Morris. Now we will look at what the suggestions and how it's applicable to our patrice. Why this is looking for patrice in the question, what's your position, we need to look at. Now what you have to do, you need to analyze whether you need to analyze income tax liability of Mr. Morris in for 2 months, December and January. Besides that, you need to analyze whether Morris is liable to pay tax in Sri Lanka. Then obviously the second one, it's asking on the tax computation, then it's a liability is there. And third one, what's the implication? The patrice. Then in here, counterpart be very interesting, which is Morris is a citizen of the citizen and tax resident of Finland. Citizen and tax resident of Finland. Then for us, definitely he is a non-resident person. And he is a director of TTL. Director of TTL. TTL is a resident company. Which is Morris physically visits Sri Lanka for all the board meetings. Only for board meetings. Again, board meetings in the 183 days and more, then it's only for the board meetings, and that's why it's given. Assume Morris is a non-resident of Sri Lanka. The company director, the monthly director fees of Morris for the attending such board meetings is $8,250. This is very important. What is the important thing for me? Not the figure. My biggest concern is on this. Monthly director fee. At the exam pressure, I'm highlighting this. This is monthly director fee, not per annum, not for first 9 months, not for next 3 months. This is monthly. And it's in the US dollar. Assume that you are the assume that you are the tax consultant with I'm really sorry. Assume that you are the tax consultant with your own tax patrice. Morris approaches your firm and requests for an initial meeting during which the following points were mentioned. Then what are the 3 points given? I'm doing my own patrice. Then I have a client called Mr. Morris, and he has approached to me by taking these 3 points. What are those 3 points? Morris is interested in understanding the increase in income tax payable on the director fee based on the recent amendments to Inland Revenue Act. Obviously, I can help. For 22-23 first 9 months and the second 3 months. For first 9 months, it goes up to 6, 12, and 18. After that, it's for 36%. And for first 9 months, for the total, it was a slabs 2,250,000. Next 2,250,000, and the balance 18%. And after that, for next 3 months, 125,000, it's going up to 30% and the balance on 36%. Since in the question, assume Maurice is a non-resident for Sri Lanka, then no tax-free allowance is nothing. On total tax, the assessable income, it's equal to taxable if there are no qualifying payments. The reliefs are not applicable to Maurice. Then likewise, it's going. Then yes, I can advise. The second one, Maurice suggested that 60% of the director fee could be remitted to his bank account in Sri Lanka, and the balance could be paid by TTH to his account in Finland. TTL could subsequently reimburse this amount to TTH as a management fee. Now there is an arrangement. Now this 2,850 US dollar, he needs to divide to 2, 60% and 40%. 40% goes to his should be paid by TTH, and it's going to his bank account. But Lamai under section 73, 1A, what it has mentioned for employment income, wherever it has paid. Given wherever it has paid, you need to look at where it has exercised. Now it has exercised in Sri Lanka, then even he has divided into 60 or 40, whatever, he has to pay tax in Sri Lanka. But the arrangement which is taking it as a management fee and remit, it cannot be accepted. Now come to third one. Maurice has expressed his interest in seeking tax compliance service from your firm if the balance 40% of his director fee, which is directly paid to him in Finland, could be omitted from APIT and his personal income tax return. Now, it's not impact to TTL because TTL 60% APIT deducted and everything done. Now, question on the personal income tax, there is undisclosed income of the 40% of the director fee. And because of the undisclosed income, if I have accepted, I'm helping for tax evasion. Now, these are the 3 scenarios, very practical, very interesting. And what it has asked, then analyze the tax when Maurice shall pay tax in Sri Lanka, compute the increase compared to this tax rate changes, very easy. Third one, an explanation of whether or not it will be acceptable for your tax practice to accept the engagement based on the suggestions made by Maurice. No, we are not going to accept. Then these are the 3. Then how are you going to answer? For the first one, analyze whether Maurice is liable to pay tax in Sri Lanka. Yes, no. Because he is a non-resident individual, he is under which is in section 69 subparagraph 1, then he is a non-resident. And since being a non-resident individual, from his assessable income, he has to pay tax in Sri Lanka where it is arising in or derived. Then assessable income, there is employment income. Now the director fee, is it employment income? Yes, it's in the section 195, very clearly provided employment, employer and employee. Accordingly, under the employment, the director is there. Then his director fee is a part of the employment income, done. That employment income, wherever paid for him, then in Sri Lanka, if it has arises, he has to pay tax in Sri Lanka. That's for the first part. Let me come to that first part and finish off it first. This is on the part B. In part A, Roman 2, payment for software application of Article 12, I have discussed. Then in the part B, which is memorandum, then I couldn't remember what's the date of exam, but I have taken like this. Date to Mr. Maurice and from tax consultant. Then from income tax liability of a non-resident individual in Sri Lanka, that's the first part. Then in here, quoting from the section 73 1A, source of payments. Sorry, in the source of payments with reference to the non-resident person, payment received in respect of employment, to the extent derived in respect of employment in Sri Lanka, wherever paid or if paid by on behalf of government, these are very important. Then where the employment is considered as the source in Sri Lanka on behalf of that non-resident individual. Done. And the second one, as mentioned, you are a director of the TTH. Now we are giving the answer for Mr. Morris. As per section 195 interpretation, employee and employer and employment, these things were given. Then under the employment, the deposition of the director has included. Then therefore, this is on that. Then therefore, Mr. Morris is an employee, employee, and the income generating from the employment subject to income tax in Sri Lanka as per the first schedule, subparagraph 10, which is subject to APIT Gazette notifications. Then the next one, which is now this is the provisions of the Inland Revenue Act. Now the question is in here, which is asking, and the double taxation agreement. What double taxation agreement you are going to look at? Is it Singapore one? No, there is a Finland double taxation treaty. Since I don't have the full treaty, I'm coming to paper and I'm coming to last one on director fee. This is the double taxation agreement between Sri Lanka and Finland, which is here. And director fee, Article 16, how to tax according to DTA. Director fees and other similar payments derived by resident of a contracting estate in his capacity as a member of the board of directors on any other similar organ of a company which is a resident of the other contracting estate may be taxing that other estate. We have to go with taxing rights of in Sri Lanka. How the tax applicable in Sri Lanka? Then we have to go, because in here what's the tax rate and anything not provided. Then we need to go with the domestic law. Therefore, then since there is a DTA, you should apply the provisions of DTA. And however, as per Article 16 of the DTA between Sri Lanka and Finland gives Sri Lanka taxing rights. The Sri Lankan law we can apply according to that on director fees paid to non-resident. Therefore, there is no treaty benefit to be available as the employment is exercised in Sri Lanka. The entire director fee he has to pay tax in Sri Lanka. Okay? And even if part of it paid directly to the bank account in Finland, why? It's very clearly given wherever paid is not applicable. Okay? Then this is on that part, which is in the question paper. First bullet, the answer we have provided. On first bullet answer, we have provided. Then compute increase. It's a very easy thing, but in the easiness, where is the answer here? Then in the easiness, then we have to, I think it's visible for you all clearly. Then here, what you need to take. These are the things, Mr. Morris' computation of increase of the tax liability comparable with December to January on monthly basis. Now, this is important. That's why even in the question, I have put it as the monthly. When first I'm reading the question also, I read it twice, but taking this is up to December or to up to first 9 months or next 3 months or for month. Then again, looking at, okay, I understood it's a month. Then the same thing can be happen to you. Then it's the employment. Then I have put everything in clearly for me to clear things. Then employment income is a US dollar. It's the 8,250. It's per month. Lamai, since it's per month, for applying this, what you have to do, don't make the horrible in your life. If this month, you can either go for 2 options at the exam. One option is take 8,250 multiple by 9 and apply it first 2,250,000 like that. But see the requirement. is a requirement of the paper. It has asked monthly tax payable. This is the requirement. In January 2023 compared to December 2022. It's monthly asking. You have to answer for month. Then therefore, what I have done, now it's for first slab. Slab is for 9 months, 2,250,000. Then for 1 month, it's divided by 9, 250,000. Then it's first 250,000. This is what I have done. This is 2,850 in LKR. It's a 320. And I have taken that and do the calculation. First 250,000 at 6%. Next 250,000 at 12%. Then on balance 385,200. Okay. Then my total tax liability is this. And next one from January month, my first 3 months, the slabs was 125,000. It's for 3 months. Then for 1 month, it's a 41,667. Okay. Then for that, up to 30%, 1, 2, 3, 4, 5, 30, up to 30%, then it's going like this. And for balance, it's a 36%. Then it's the tax liability is 912. 899. Let me take it for without cents since I have taken all like that. Then increase of the tax payable is a 52,500 compared to December to January. Okay. Then this is the answer. Very, very easy calculation, but you may be struggle with this. Okay. It's a reading the question carefully. You can, reading the question carefully, you can take the points. And that for second bullet. An explanation of whether or not it will be acceptable for you tax patrons. No, I'm not going to accept that. Why was the reason? I'm helping to I'm encourage a taxpayer to tax evasion. Then if I have helped so, then the penal provisions applicable for me also. My code of conduct, code of ethics is in a risk. Then I have risk for my professional behavior. I have risk for my integrity. Then therefore, it's not issue for confidentiality. Then I have issue for this too. Then therefore, I'm not looking for in a unique way for all my clients, and I'm helping for tax evasion, willful evasion, and negligence. Not like negligence or willful evasion. Then therefore, I'm not going to do this. And I need to advise you, Mr. Morris, you will, if this found as a guilty, you have to pay penalty applicable. In section 183, 184, these things, we have the particular penalty provision. And again, section 126 applicable for me. The helping for incorrect statements by reducing the tax liability, then I'm not going to do that. Then I need to tell it to him, which is in my memorandum, then in here, which is in that employment income, the conclusion part, the liable to pay tax in Sri Lanka, which is supported by the Gazette, which I have explained. Computation, separate annexure attached, I have discussed that. Then the accepting of the engagement as requested by you. No, we are not going to accept. The request of you shall not be accepted. It provides stress to the fundamental ethical principles. The professional behavior and the integrity will be highly questioned due to agreed for non-disclose the actual income received and coaching for tax evasion. I'm not going to do. Therefore, advise to disclose total income and pay tax accordingly. If not, you may subject to penal provisions as per Inland Revenue Act. A simple answer which it has given. And when it comes to this question, highly patriarchal. Highly patriarchally, a very good question actually for students to earn the marks. Okay. Then this is for end of the answer discussion of the section 1 questioning. Sorry, section 1 question 1. Okay. Then I can move to the question 2. I think no question. The participants are okay. There is a question. What's the question? No, if there is a no permanent establishment, you cannot tax the business income. Under Article 7 of the DTA and the Section 73, subsection 1M Roman 2, then it's very clearly given for you to tax the company. Then for business income, there should be a permanent establishment. The income and expenses attributable to the permanent establishment, only you can go for the business income. If there is no PE, you cannot tax the company in here as the business income as a separate enterprise, but the withholding tax provisions will be applicable on the remittance, outward remittances, what they are receiving, which is a final withholding again because they don't have which is a permanent establishment. Okay. Then any questions? Nothing. Then let me come to question 2, a kind of a different, a very different angle of a question, but it's again, if you have read the question carefully, and it's a different means, not in a traditional manner, very practical manner. Again, it has given. Then you have to read this carefully, and you have to do the adjustment. It's a actually speaking, if I have taken the facts of the thing, all the commonly students who can take the marks on the general, that particular input VAT, zero rated supplies, exempted supplies, that total knowledge, you can obtain this marks. There's a 15 marks, all the 15 marks you can take, okay? Then let me clear the question again. Okay. Then, which is on the question 2, let me come to the requirement. This is a requirement for 15 marks, very easy. It's a easy mean, you have to read it, and if you have understand the points, you can take this 15 marks. Outline the relevant provisions of the VAT Act, number 14 of 2002, as amended, which could be attributed as reasons for disputing item 1 to 4 highlighted during the tax health check. Then it has asking on the, they are talking about the tax health check. In the tax health check, then they are asking there are 1 to 4 points were identified. On this 1 to 4, you need to outline the relevant provisions of the VAT Act. Then reasons, and you need to tell the reasons why there are disputes like this, 1 to 4, why there are disputes. Then with the identification of the disputes, I am coming to the calculation part also. Then it's easy. Then the Roman 2 is on the calculation. Prepare the amended summary of the VAT return for the period and calculate the penalty arising on the additional liability, if any, up to 31st May 2023. Prepare the amended summary of VAT return for the period and calculate the penalty arising. And calculate the penalty arising and prepare the amended VAT summary. For these two, not the penalty calculation, but for this preparation of the amended summary, I'm doing with the question itself. Then it's easy. Then here, question 2, C&G Consultants Private Limited, C&G, is engaged in the business of providing consultancy services to local and foreign clients. What's their principal business activity? Is the business of providing consultancy services to local and foreign clients. Income received from foreign clients represents more than 70% of the total turnover of the company. Now, I am providing the services to foreign clients and export of service in Sri Lanka, and I'm providing services to persons outside Sri Lanka, genuinely I'm getting income from foreign currency, maybe within 6 months it's receiving. Then my more than 70% of the turnover, then it is from what? It is from this export services. Then therefore, I can register as whom? I can register as RIP since I am direct exporter, and I can register as the RIS also, because from my total turnover, more than the 50% is going to this export SVAT in that combination, then I have the export. Then CNG is registered as registered identified purchaser as well as a registered identified supplier under the simplified value added tax scheme. Then in the board, they are registered. The management of CNG retain the services of a third party consultant to conduct a special tax health check. They have taken the opinion of the tax consultant to check whether their computations are okay. During the assignment, the following information was identified with respect to value added tax, but for the taxable period ended, it's April 2022. Now, Lamai, what's the first thing when reading the question? Are you going to blindly apply the tax rate of 15% here? No. Then you have to identify I being exporter. Or I being a person who providing zero rated services. Then under the taxable period, under section 83 of the interpretation of the VAT Act, there are two taxable period of 1 month and the taxable period of 3 months. Then being an exporter, I shall file the VAT return for a period of 1 month. Then when it comes to this period, taxable period of 1 month, which on April 2022, what's my tax rate? Is it 15? Is it 12? Is it 8%? It is 8%. That your particular knowledge on the changing of the VAT rate, it's totally applicable for this marks. Therefore, when reading the question, read in open eye for you to take these points clearly. Then, summary of VAT return filed for the April 2022, which is monthly return. Then under that, value of supply and VAT, the turnover zero rated supply SVAT standard rate, and the local purchase VAT registered persons SVAT credit, monthly payment made and balance payable, everything given. Items disputed. Now we need to look at this item disputed 1 to 4. What are the items disputed? For first one, item disputed by the third party consultant. Then first one, zero rated supplies includes. Now, before this, let me come to here. What should be included in the zero rated supplies is mentioned in the section 7 of the VAT Act. In the section 7, there may be zero rated of goods, there may be zero rated of services. Now this is on the service. Even goods or services other than with reference to that international transportation thing. Now in the provisions of the central bank and the provisions of the VAT Act, we have what foreign exchange, that it should be comes from my foreign debtor within 6 months from the end of the taxable period which that supply has attached to. Then if it is so, we are considering it as a zero rated. And to consider as a zero rated, we shall provide, I will attach the services. We shall provide a service. I being in or outside Sri Lanka, I can provide the service. A person who is outside Sri Lanka to be utilized or consumed outside Sri Lanka, and the income should be came to me or transferred to me in the foreign currency in my account maintained in a commercial bank, and it should be within 6 months. That is the thing. Now that's you have the idea. Now come to here. The particular 2 bullet points given, is it zero rated? Zero-rated supplies include services provided to foreign clients amounting to rupees 2.8 million, where settlement received in LKR. Now my question, is it zero-rated? No. To be zero-rated, it should be received through what? It should be received in foreign currency. The cash received, money received. But this has received in LKR. If it is received at LKR, what is the thing? Is this zero-rated or liable or exempted? It is exempted. Now, where the exemption has given? In the first schedule, part 2, it has given the supply of services to the person outside Sri Lanka. If the money has received in LKR, it is exempted. Now, what has happened to us? That exempted supply we have recognized as zero-rated. Then, incorrect. What's the implication? One is that, and the second one, what is the implication? The implication is if you have recognized something as a zero-rated, it's a zero rate, then it's a taxable supply. How many taxable supplies you have? We have 2 taxable supplies. What are those 2 taxable supplies? One is a 0%, other one is on my standard rate. Then, being a taxable supply, did you claim the input VAT? Yes. In here, indirectly, of this supply, you have claimed the input VAT. Then can you claim it? No, you cannot. Now, these things you have to analyze. And that's for the first bullet point in the first dispute. It's not the zero-rated supply. Then it is a exempted supply. Then input, but you cannot claim. You have to disallowed. Then the second thing, which is the services provided to foreign clients amounting to rupees 1.1 million, where invoice remain outstanding as at 31st May 2023. What is this point? That 6-month provision, very latest provision. Now it's a 6-month provision. What it has given? Services provided to foreign clients. Of course, it's a 70% of my turnover is coming from foreign clients. Then I have done a supply of foreign service of rupees 1.1 million. Invoice remain outstanding at 31st May 2023. What's my taxable period? So April 2022. Then in the April 2022, then if it's my taxable period, then now how many months gone? April 2022 to 30th April 2023, almost 1 year gone, and there's also 1 month gone. Then therefore, what's the thing? Can we take this as a zero-rated supply? No. The new provision is not new. If the 6-month provision is there, therefore you cannot consider this as a zero-rated supply. Since you cannot consider this as a zero-rated supply, again, input VAT attributable to that, you cannot claim where it has mentioned section 22 subparagraph 6 in the next subparagraph 4 it has mentioned. That's the second. First dispute, the 2 things. And let me discuss this and come to the question, the calculation. And the second one, the local purchase invoice amounting to rupees 780,000 exclusive of VAT, dated 2nd January 2021, was included under local purchases in the above computation. Now what has happened? A local purchase invoice. Now, to claim input VAT for invoices, what's the condition? It should be valid tax invoice. To be a valid tax invoice, what should be satisfied in the section 20 as a tax invoice, all the formats and everything should be there. Other than that, under section 22, subsection 6, what it has mentioned, to be a valid tax invoice for local purchase, it should be claimed within 12 months period from the end of the taxable period where the invoice has related. Then therefore, what has happened? The date of the invoice is 2nd January 2021. Now we are in which period? We are in the 2022 April. It has claimed almost the 12 months that has expired. Then it's incorrect. Again, the purchase, we cannot claim 780. Third one, the company has accepted 2 tax invoices from SVAT registered suppliers. This is that. The company has accepted 2 tax invoices from SVAT registered suppliers RIS amounting to rupees 1.2 million exclusive of VAT, and the same was included under local purchases. Lamai, I am RIP and I am RIS. Then I have the purchases from RIS. I am RIP and there is RIS. I have purchased from the RIS. Now, if I have purchased from RIS, being RIP, I should only can accept what? SVAT invoices. I can accept without SVAT invoices, tax invoices from a person who are not registered for SVAT. And that person shall pay it and I can take the refund. It's in the SVAT gazette notification. Then therefore, what's the situation? What I have done, the suspended VAT, which I cannot do, I have claimed under the local purchases. Then therefore, this particular purchase, 1.2 million, it should be relevant to my suspended purchase. And I have issued the, and I have, and without having the SVAT scheme, I have purchased this. We cannot claim this one. And it is a third dispute. And the fourth dispute, a tax invoice referred to the payment made to hiring a car for a director, use amounting to rupees 140 exclusive of VAT was included under local purchase. Any traveling purpose motor vehicle, again section 22, subparagraph 6 in the Roman 1. Any traveling purpose motor vehicle, you cannot claim where lease, insurance, hiring, repair, anything you cannot claim. Unfortunately, we have claimed it. Therefore, this all 4 disputes agreed and accepted. Then therefore, based on that, we need to go for the prepare the amended summary of the VAT return and the what's the penalty on the additional tax. Penalty is 10% and the after that on all parts or the full months after that it's the 2%. Okay. Then let me come to the computation of the VAT, which is here in that, which is on the C&G Consultants Private Limited, and the amended summary of the VAT. This is not the VAT computation, this is amended summary of the VAT return for the period of 1 month ended 30th April 2022. Then output what? Zero rated supply. Now from the zero rated supply, in the question, it has given the zero rated supply is 29.3. From this 2.8 million, we cannot consider as a zero rated supply. Then this one we have to eliminate. Then I will eliminate that from the computation. Here it's a 26.5. With the reason and everything given. Then next one for SVAT. And the here for SVAT no change, standard rate no change. Then let me take that 2 as it is, which is SVAT 2,520 and the standard rate 12,200. It's coming to the rate of 8%. Done. And we have identified exempted supplies based on the explanation for dispute 1. Then it's 2.8. Then if I have coming to this,
in the question 2. These are the disputes and the particular provisions of that, everything has explained. Since I have discussed verbally, I'm not going to go for the detailed answer, which is on the for this thing, but I need to come, which is the value. This question was tested with the value-added tax with business decision-making part and the tax rates. These are the changes. The changes to VAT rate relevant to the period 1st Jan 2022 to 31st March 2023. Now, this is a change. It's another change is there for 2024. Then in question, the testable month is April 2022. The applicable tax rate is 8%. Then the outline reasons for dispute as per the provisions of the VAT Act. Then this is the dispute 1, which is the service provided to foreign clients. Then it's a justification why it's not being a zero rated, and it's coming under exempted. The conclusion thereby the recognition of exempt supply as zero rated supply, which as a taxable supply is incorrect. Then this is the first part. And the second one, which is the invoice remain outstanding, which highlight the 6-month provision, and the section 22(7), which is the which is the 22(7), 22(6), subparagraph 4, which is on the why it's not taken as a zero rated, the input should be disallowed, and both that too has discussed. The conclusion I need to come. Therefore, shall not be considered as zero rated supply, and as per the section 22(6), 6, then it should be 4 or 6, the attributable allowable input VAT, common input VAT or directly attributable input VAT, then shall not be allowed to deduct because the 6-month provision has lapsed. The provision read as follows, and the particular provision in that it has given. Then the dispute 2, claiming of input VAT credit, which is on the exceeding the 12 months period of that particular provision, and how it should be as a valid tax invoice, and what's the conclusion according the local purchase invoice issued on 2nd January 2021, claimed after expiration of 12 months period and shall not be considered as a valid tax invoice. Then again the particular section 22(6) provisions were quoted, and the inclusion of SVAT purchase, it's a quoting from the Gazette notification. We cannot do that. Then in the Gazette, if you have familiarized with the Gazette, this is very clearly mentioned. Then we cannot claim the input VAT. And the secondly, finally, which is a claiming of input VAT relevant to tax invoice which received for hiring of motor car. No, we cannot claim that, which is in the input VAT attributable to motor vehicles used for traveling, including repair, lease, hire, insurance, we cannot claim. Therefore, this should be eliminated from your local purchases. This question is not talking about import purchase. No import purchase because service-oriented organization. Therefore, then these purchase you have to remove. Now let me come to the computation. Then in the computation, this under here, under dispute 1, the exempted supply has identified. Now, again, let me come to the section. In here, local purchase for VAT registered person, all the changes we have to take this 9.2 million. In how we are going to do that? In the calculation, in here, which is that, in here, working for local purchases, then local purchase, as per original computation, 9,200.
you cannot claim less adjustments under disputes. These are the adjustments under disputes. Then not supported by valid tax invoice in dispute 2, 780 you had to remove. Expert purchase invoices included in local purchases. You cannot claim that 1,200, and hiring expense on motor car used for traveling purpose 140. Then total local purchase after adjustment. This is not the VAT component. This is a local purchase. Then therefore, I'm coming to tax computation. And here, all others, the output VAT side we have considered. Then this is total of my exempted supply. This is total of my standard rate and the 0%. And this is total for exempted and the value of supply of the taxable part. And the after applying standard rate, this is my output VAT. Then input VAT, local purchase, it's in the working one. I have directly taken from the working. What is the local purchase eligible to claim under the input VAT? Then for 8%, it's the 566. Then this is my total input VAT. Then for this, we have exempted supplies. Is the one thing. And the other part, what we have, this 43,950,000 in this zero rated supplies, we have 1,000 or 1.1 million, which we have included as a zero rated. It doesn't matter. It's very clearly section 7 given. If the 6-month provision was not there, only the penalized thing is we cannot claim the input VAT. And make a gila see a data tax when this is not the application for the 8% or 15% is not coming. But input VAT we cannot claim. Then therefore, for that 1,100, that input VAT relevant to that we cannot claim. Then with that mind, I'm coming to here, disallowable input VAT I need to compute. Then under the disallowable input VAT, the disallowable input VAT in note 2, on exempted supplies 2,800. On zero rated supply, which the payment has not received within 6 months from the end of the taxable period. Then it's 1,100 and this is my total. Okay. Then this is my total 3.9. Now I need to come up with what? To computation of the disallowable input VAT. How to compute the disallowable input VAT? I have input VAT 566 and my total, the supply, which is on the 46,750. Then for this, I need to multiply by my disallowable, which is on disallowable per the items which exempted and the zero rated which is not received through the 6-month part, then it's 4725. Then this is the answer. In this, then what I have allowable input VAT for the period, which is 590. Since I have SVAT, since I have zero rated, I need to the apportion. This is looking for VAT return. In the VAT return, this is something compulsory, part and partial of the VAT return. Then this apportionment you should have to do. Then in the apportionment, let me do the apportionment. This is 519 and it's for my 46,750. Then in that 46,750, then here, which is for this one, you need to multiple. Sorry, I think I have made a mistake. Here 519 apportionment and you need to take 43,950 and in the 43,950 you need to multiply this by the 2 supplies. One is my zero rated supply and other one is my SVAT supply. then it is 375, and I need to compare this with the total output VAT, 100% of the output VAT, or the balance from this calculation, which is 144, which is whichever is lower, then 1396 or 144, whichever is lower, then lower one is 144. We have claimed this, and this is my allowable input VAT for the period. Then this is my total balance VAT payable, VAT payable, and from that I need to take the tax credit. In the question it has given the tax credit 240, VAT credit 420, no change for that. Then 240 and 420, which is then I'm ended up with the balance VAT payable. Obviously, I have additional tax liability. I am a defaulter. Then for this additional tax liability, the application of the penalty provision, this is a theoretical part of the penalty provision, section 27 of the VAT Act, up to the 100% of the tax VAT liability, they can charge the penalty. Then let me come to the penalty calculation, penalty computation of additional liability. What is the original due date of the payment? Now we are in April. Then we have to make the payment on or before 20th day of the subsequent month. If you have made the payment, you would have to be it on 20th May 2022. But up to now, the examiner has given a timeline 31st May 2023. Up to now, you have not made the payment. Then therefore, additional tax payable as per our calculation is 217 on this 10% before the first day. That's been a 20th midnight, 21 onwards, now 21st onwards, 10% is there. After that, for pending each and every month is a 2% applicable. Then accordingly the 2%, it's a 217 on 2%. It's not 24 months. I'm sorry, it should be 12 months. The total answer 24. No, then I was done a mistake. Then this is the penalty application. Okay. Then in that, the 10% and the 2% application, the penalty for default section 27. Then this is the theory part. The maximum up to the 100% of the tax liability you can claim. This is the end of the discussion of that, the 15 marks. And I need to come for next 25 marks. Very easy calculation and very easy explanation again. What is asking? The requirement 1 and requirement 2. Then requirement 1, analyze whether LSL can reduce its product cost by applying any provisions of the VAT Act number 14 of 2002 and subsequent amendments. Let me come to this part first. Now, analyze whether LSL can reduce its production cost. Being applying the provisions of the VAT law, can this so-called LSL reduce the production cost? Come to that. Lead Suppliers Private Limited, LSL, is in the business of wholesale and retail sale. That is their business. Of janitorial supplies in the central province of Sri Lanka. All the cleaning items they are going to supply. LSL recorded a turnover of 65 million in the financial year ended 31st March 2023. And the estimated turnover for the current year remains the same. That means for this year also, it remains the same. The company mostly conducts business with corporate customers who are registered for VAT. Very, very important. I am doing my business with the persons who are registered for VAT. LSL purchases products directly from manufacturers who are also registered for it. My purchase, that's the question, Lamai. Now it's asking on how to reduce my production cost. I am purchasing items from the manufacturers who are registered for VAT. Then, since they are registered for VAT, they are including VAT component in their price. Now, however, poor LSL is not registered for VAT. Now, the correction. Hence, that on purchases, particular input VAT charged to the P&L and it considered as a cost. That's the reason they're asking to reduce the production cost. How so going to take the help of the vector. Now, by reading this, what you can see is that my threshold is enough to register. It's a 65 million. What's the current threshold? The 20 million per taxable period of 1 month or 3 months, and the 80 million per annum. In my case, is I have exceeded that? No. Then what's the option? Under section 10 for the forced registration, I cannot go. But for section 12, voluntary registration, I can go. In the voluntary registration, if I have registered for VAT, I can issue the tax invoice and I have to pay VAT. And meanwhile, I can claim my input VAT, my production cost. The production cost increase can be reduced by the VAT component. Then that's the option for the 5 marks. Very easy. And here, which is in it's not a detailed answer again, which I have taken from the question. Action verb is to analyze how to reduce the production cost, how by using the provisions of the VAT Act. In the details of the scenario, turnover per annum 65 million, 22, 23 and the current year. And most of the customers registered for VAT, most of the suppliers registered for VAT. If registered for VAT, can claim input VAT. That's the hint. And can apply forced registration under section 10? No. Can apply the voluntary registration? Yes. Can apply the voluntary registration? Yes. Section 12 voluntary registration and get the benefit of claiming input VAT and reduce the production. The simple answer, step by step. In your detailed answer, if you have included this everything, yes, you can take the 5 marks. And next, which is the second question, compare the implications of drawing a salary against drawing dividends and explain what would be more benefit to someone going forward, giving a due consideration to his status as the sole shareholder of the company as well. Now it's asking for decision. What is a decision? A comparison of the it's good to draw in a salary or dividend, and your explanation shall be made not only looking for individual person, Mr. Saman, but also you have to look at for company. There is a company, this LSL, for that company also, for 5 marks. We will look at the second paragraph. Saman is the founder and sole shareholder. Now, founder and the sole shareholder, and also works as a chief executive officer, CEO employment of the company. He drew a monthly salary of rupees 600,000 during 31st March 2023. It's giving 31st March 2023. Therefore, actually, I have looked into 23-24 what's the position, because it's tax planning question. Therefore, the accountant of the company is of the view that with the amendments introduced recently, drawing dividends instead of the salary. This is my concern. As a student, this is my concern. Drawing dividends instead of salary would be more beneficial to someone, since withholding tax on dividends is only 15, and don't forget under section 88, it's a final withholding payment. Now the question number. Basically, looking at the, just looking at this, you also tell, okay, the dividend declaration, or if that's a 15% and final, it's done. For salary, I have to pay APIT up to maybe 36%. 600,000 mean in 23, 24, it's up to 386 something. Then it's, yeah, it's going to 36%. Then like that. Okay. Then therefore, just looking at this scenario, you will tell, okay, dividend is good. But what's the examiner asks, Lamai? Examiner asks, giving due consideration to his status as the sole shareholder. Lamai, this LSL, which is I'm drawing my salary, it's my company. I'm the shareholder and I'm the CEO. Then I need to look at the angle of myself as well as my company. Then therefore, what you need to look at both angles. Now, my dividends. What's the double entry and what's the position of the dividend? Dividend we are paying from the retaining earnings, which the going for the statement of changes in equity. Is it coming to our income statement? No. What's the position of the salary? The position of the salary is my expense in the income statement. Since I am paying the APIT under section 10 subparagraph 2, I can deduct it in computing business income since the relevant WHT has deducted. Then I'm saving 30% of tax on my salary. Salary මට අඩු කරන්න පුළුවන් වීම නිසා since the tax salary shall be deducted, then my profit shall be reduced on that. Then I'm saving 30% of tax. By declaring dividend, here is benefited to me. But what's the examiner asking? We need to look at the company also. Then on that angle, then first thing is 600,000. If I have taken per annum, it's 600,000 per annum. Then it is the 7.2 million. Then 7.2 million, it's a deductible since I am paying APIT. Then it's if it is deductible, if I have taken 30%, is a 2,160,000. I am having a tax saving. On the other hand, since I'm going for adoption now, then since I'm going for 600,000 of salary, I'm not going to I'm not going to obtain the dividend. Then I'm again saving my opportunity cost, which is the 15%. Then in the both angle from the company and from myself, then the salary is good. Now in this question, if I have asked without considering company, what's a good option to Mr. Sama? Now my definitely good option is a dividend without considering the company. But in here, you have to think a wide angle. It has asking on the position of please consider me also. That's mean my company. Then in the 5 marks, it has given to the solid analysis of this second paragraph. Now come to the answer, which is the comparison of implications drawing salary against the dividend. Again, only the answer points, Lama. I have not gone for the detailed answer. Note, from the both side of the company and Mr. Saman, since Mr. Saman is a single shareholder, I have highlighted this fact. My total answer based on this concern. Then salary compulsory APIT deduction, APIT per month, then it's from 1st April 2023 because I have taken for future. Then cost of employment to the LSLs as the expenditure under the administrative expenses for the income statement is a 7.2. And since the relevant APIT has deducted, this is an allowable deduction under section 10 subparagraph 2. Therefore, corporate tax will be reduced. Based on the new tax rates from 1st October 2022. And the dividends is the final withholding, not impact to the income statement. And explanation, which is since the Mr. Saman is a sole shareholder and the CEO of the company, by analyzing both angles, the most benefited option is obtain the salary. From looking at both sides, company and individual, since there is a tax saving of this much, 2,160,000, which I have shown roughly on the figures, on corporate tax, and again by not taking the dividends, there is a saving of 15%. Therefore, opportunity cost plus current tax saving is a 45% is applicable. Okay. Then this is on the end of the second question. And with this is end of the entire paper discussion. The first part is non-resident and taxation and business decision making. Second part, VAT and tax planning, taxation and business decision making. And the section 3 is totally with the administration, case law provisions, computation, tax planning and advising, everything. Okay. Now let me come to your questions, which is madam, if it is, let me stop share. Then let me come to here, which is madam, if it is a service fee for non-resident, WST is applicable, and after deducting WST, need to tax on the employment income. Okay. Service fee is not the employment income. Service fee is from the independent service provider. The employment income is from the dependent services. Then you're asking, madam, if it is a service fee for non-resident, WST applicable, and after deducting W, do we need to tax under? No, the service fee is not coming under employment income. The service fee is provided by the independent service provider, not from the employee. Then for service fee, it's a if you are paying it to non-resident person, then it's a 14% applicable. Then it's not the employment income. Okay. Any other questions? I'm looking for questions. Then it's under income tax for resident. If there is any income received after deducting WST, what is the amount to be taxed under business and investment? Again, is after deducting WST for net amount or the gross amount. Let me highlight like this. We have two kinds of the withholding payments. One is a final withholding payment, one is a non-final withholding payment. Your question is related to non-final withholding payments. Non-final withholding payment, if I have taken interest rent like that, then for this, the first thing is we need to remove it from the, if it is an investment income, I'm always going for if clause. If it is an investment income, like in the rent of the particular investment asset and the interest income from the FD, then first thing, it's not attached to business income. You have to remove it from the business income or profit before tax. Whatever is charged to your income statement, you have to remove. And the second thing, when it comes to particular source of income, accessible income from investment, you have to take the gross figure. Then if the interest received 95, you cannot take the 95 for the accessible income from investment. You have to take it 100, which is gross figure, you need to take. And the gross figure, even rent, even interest, I'm addressing on the non-final withholding payments, and you have to take the gross figure. And after that, what you have to do, under tax credit, you need to take the relevant withholding tax credit as a deduction from your tax liability. And for the non-final that application and the final withholding payment for typical example dividend, then it's the final withholding payment again, which it has included in your other operating income. If it has included, you have to remove it from the PBT, and you need to present clearly in your accessible income from investment, what's the liable dividend, 15% deducted, and it's under final withholding, not coming to accessible investment income. And again, dividend, you have to look at what should be exempted dividends, which is dividend distributed out of dividend income, that should be shown under the exemptions and not coming to accessible investment income. Then you have to show in the, which is on the final withholding, gross, what's the 15%, what's the net, and only show, and you have to take it under final withholding, not to take under the accessible investment income. And this is the difference of the final withholding and non-final. In your question, WST, what is the amount to be taxed? It's a gross. Under the accessible income, it shall take the gross, and you have to take the tax credit. And second, if the dividend received from resident company for the period is final for the period from from the 1st October 2022 to 31st December 2022, they have Department of Inland issued the first paper notice, and from the after that, your 45 of 2022 Act, after that there is another amendment for 2324. In the amended Act, they have very clearly mentioned its a rate is a 15%. It is the income tax rate. It's the income tax rate for the intermediate period of the 1st October 2022 to 31st December 2023. It's a 15%. And after after that, with 1st Jan 2023 onwards, 15% final withholding. Before that, till 30th September 2022, it's a 14% income tax rate. It's only on the liable dividends, not on the exempt dividend. What is a new circular for 25% of non-cash benefit? What 25% of non-cash benefit? What is the new circular of 25% of non-cash benefit? They are in the employment income for new circular is not applicable for you all. But even in the new circular, I am looking for this 25% thing. Like vehicle allowance. For new circular, which first issued from the February and retrospectively applicable, and again there was a change for that, and like we are using that in that non-cash benefit, actually I don't come up with this 25% thing. Then in the new circular, it's very clearly included these things on the vehicle benefit. It has included, and the vehicle benefit up to the 50,000 total. And the second one, it has included the housing benefit based on the salary, very not like you learned one. The new one, it has very clearly mentioned, which is the simple manner, which is based on salary on the rated area, unrated area in state Bangalore, how it's going to take the particular non-cash benefit, vehicle, house, and the value of share, and the other benefit. The telephone benefit, which is on the telephone health insurance thing, and those things are given. And this 25% actually the something I think I don't know. And I think I have given the related answer for you according to the new circular, what we are applying today. Any questions? I think there are no questions, seems to be. I can wait for your questions. Anything on related discussions today? Seems to be nothing. Then let me wind up the session. Yeah, let me wind up the session, and thank you for okay, there is again question. Madam, in VAT on FS, when calculation economic depreciation for additions, do we get the economic depreciation for whole year? Yes. It's economic depreciation for whole year. You need to take for entire year. That means it's for the yearly calculation. Now, if for the biannual calculation, now you cannot take the whole year. Don't make me mess. Then in here, based on the requirement you have to address, definitely, it may be for the biannual calculation, it may be for a per annum calculation. Then if it is per annum, definitely you can take the per annum, but it's a biannual, it's only for the 6-month application. Then it's not for the entire year. If it is a 1 month, it's for a 1 month. Then for the payment of VAT on FS, we are going for the monthly basis, and we have the interim estimates. Then for interim estimate, we have 2. Then it's a biannual statements. Then for the final adjustment, we have to go for a year. Then based on the requirement you have to apply, then have a calculation you cannot take for an entire year. It's based on your requirement you have to adjust. I think I can wait for more questions. If not, again, I'm going to wind up. There may be another question. If anything, if nothing, may I wind up the session? If there is no, I think there may be some question, but seems to be no. Then let me wind up the session. Now it's on the 12th December. Then you have enough time to study. Then you take your hard working and commitment and study in the effective manner in these days. And all of you all can pass the exam in a with what you all expecting you will receive is based on your hard working and commitment. And thank you very much for interactive participation, and wish all the very best for your examinations. And good night to all of you.